Hello, good morning and welcome to the 2024 ICAS Insolvency and Restructuring Conference. We've got a great lineup for you today, so I hope you're sitting comfortably with a cup of coffee, ready to learn some new stuff over the next 3.5 hours. But before we get into the formal business of the day, a word from our sponsors, Sweeney Kincaid. Thanks to Sweeney Kincaid, our sponsors for the conference. So word just through that we have our biggest ever audience today on this, which is our 4th virtual conference. A reminder that there are actually 2 separate sign-up links, one for the session today and one for the session tomorrow. It appears we do have less sign-ups for tomorrow, and I don't know if that's because the topics are less interesting for some of you, or if it is just that you didn't realise that there was 2 separate links, so maybe one to check. So the plan for today, in a couple of minutes, we have our first session, Lessons from Financial History for the Way We Live Now, from Professor Russell Napier. At 10:15, we've got the first of our corporate insolvency legal update bite-sized sessions from Stuart Clubb. Then we've got, over the course of the 2 days, we've got 5 different sectors in focus, and we've got construction up first with Adele Macleod and Conor from Teneo, followed at 11 o'clock. There'll be a quick coffee break before that, and then 11 o'clock we've got James Lloyd from Harper Macleod, and he's going to be doing the first of the personal insolvency update bite-size sessions. At 11:15 we have our insolvency monitoring update. We've got Lesley Byrne and Robert Mudge from ICAS, and then Joanne Wright, who's one of the reviewers from ICAW, with an overview of the findings from the insolvency monitoring visits conducted in 2023. 11:55 we have a personal insolvency panel session, discussing the direction of travel for the personal insolvency in the UK and Scotland and in England with the recent consultations that are going on. 12:35 we've got our second insolvency sector in focus with Richard Bathgate and Michelle Waugh from Johnson Carmichael. They're going to be looking at the agricultural engineering sector, and after that we've got close at 1 o'clock. So that's the lineup for today. So, and now to introduce our first speaker. So the first session of the conference has traditionally been economic outlook, economic update. We've got something slightly different this year. Our speaker, Professor Russell Napier, has worked in the investment business for 35 years and has been advising global institutional investors on asset allocation since 1995. He's the author of books, Anatomy of the Bear, Lessons from Wall Street's 4 Great Bottoms, which is a cult classic according to the FT, the Asian Financial Crisis 1995 to 1998, and he's founder and course director of the Practical History of Financial Markets course, which runs at the Edinburgh Business School. So he's also, in 2014, he founded the charitable venture, the Library of Mistakes, which is a business and financial history library in Edinburgh that's now got branches also in India and Switzerland. And I think there's one due to open in Singapore and perhaps in London as well. The title of the session is Lessons from Financial History for the Way We Live Now. There will be some time for questions at the end. So please, over to you, Russell.
Thank you, Shona. Welcome, everybody. There will be forecasts about the future in this presentation, drawing upon the past. That's not always easy when we talk about a business cycle, but we aren't living through a business cycle, we're living through a structural change. So what I'm going to discuss is the structural change that's underway in the global monetary system, our domestic financial and monetary system, and some of the implications that has for asset valuations. My own career has been focused on the valuation of listed assets, but these lessons, I think, have important ramifications for the valuation of unlisted assets. So perhaps more of a focus on asset prices than you're used to, than pure economics. But we are at this great structural segue. Now, just before I do that, I just want to say a little bit about the library mistakes and what it is, where it is, how to use it, and why we exist. So first of all, it's a real thing. It's a real building. It's got books in it. That used to be what a library is. I'm told these days libraries can be non-existent, but ours is a real thing. It's in Edinburgh's West End. It is open to you because it's a public library. And if you'd like to come along, you register on our website, librarymistakes.com, and then you can arrange an appointment. You'd also be invited to the lectures we have there on this subject, financial history and its implications for the future. And there's a podcast as well that goes with that, and all of that is free. So the question is, why bother with financial history? And it's really been in a backwater for a long time because the financial market theorists came up with a thing called the efficient markets hypothesis, which said that all available information was in the price. I couldn't have a better definition of history for you than all available information. So therefore, financial history was sort of shunted off into the background. And we focused instead upon mathematics and the mathematical approach to valuing assets, which of course is a very legitimate approach, but it's a bit like distilling. And Scotland obviously has a bit of a reputation for distilling. But it is interesting when you distill the study of finance, what you throw away. And the things we threw away are the things that we've now discovered are really quite important. Politics, sociology, philosophy, psychology. Well, we didn't quite throw them away when we became more mathematized in finance, but they were certainly pushed into a slow eddy of the river and not in the full flow. And the library mistakes exists to try and bring that back. We are also a study of human decision making under uncertainty, a phrase you might be familiar with because that was the citation for Daniel Kahneman for his Nobel Prize, and something we all do every day in all of life. But of course, in business, we live more in the future. And in investment, we live more in the future than perhaps we do when we cross the road every day. Therefore, we're more prone to mistakes. And therefore, we're studying the history of these decisions, the ones that went right as well as the ones that went wrong. The Library of Mistakes is a business and financial history library. We don't call it that because if we called it that, nobody would come. So it's called the Library of Mistakes. But we study getting decisions right as well. And we think this time and a place has now come for doing more of that. So that's what we're doing at the library. We now have some backing in terms of intellectually anyway for the role of financial history. So I just wanted to read you something before we go on to the forecasts of what is to come from Angus Deaton. Now, Angus Deaton was originally from Edinburgh. He's a Nobel Prize winning economist. He won his Nobel Prize, like most economists, for the past 30 years for a focus on the mathematics inherent in finance, or a more mathematical approach. So let me just read what he has said about why we need to shift, not abandon, but shift the perspective. And he said this recently in a statement at the IMF called Rethinking My Economics, and because it's made by a Nobel Prize winning economist, I think we need to pay attention. And this is what he said about empirical methods, so the wielding of the decimal point. The credibility revolution in econometrics was an understandable reaction to the identification of causal mechanisms by assertion, often controversial and sometimes incredible. But the currently approved methods, randomized control trials, differences in differences, or regression discontinuity designs, have the effect of focusing attention on local effects and away from potentially important but slow-acting mechanisms that operate with long and variable lags. Historians who understand about contingency and about multiple and multi-directional causality often do a better job than economists of identifying important mechanisms that are plausible, interesting, and worth thinking about, even if they do not meet the inferential standards of contemporary applied economics. So that's what we're going to do now. I'm going to talk about financial history, some of the things it tells us, and why they may be a surprise to those who are over-focused on the empirical methods. So this is a brief run through some of the lessons that I think are important now. This lecture is called Lessons for Financial History for the Way We Live Now. Some of you will be aware that The Way We Live Now is a novel by Trollope from the 19th century, which was involved with a great financial scam in the railroad sector. So if I was to give you the 20 lessons or the 10 lessons or the 5 lessons from financial history, they may be different from what we're going to talk about today, but these are the ones that are important for today. Now, you will know, even if you've never studied finance, that finance and most things in life and markets consist of supply and demand, but there's a problem with that. I've been doing this for 35 years. I meet investment managers regularly, almost daily. We discuss the outlook. And then everybody goes away and focuses on demand. And they don't focus on supply. But in working out the value of an asset, supply and future supply is important. Is it as important as demand? Perhaps not, but it's certainly very important. And yet I can tell you from the perspective of the investment management community that very little time is done looking at the supply and how supply of new assets, supply of new capacity, supply of new production could undermine prices. And of course, the reverse is also true. So for the past 30 years, and it's 30 years exactly, not quite to the day, but almost, since China devalued its exchange rate in 1994, China has been adding at incredibly low production prices, more and more capacity in a way that has never been seen in human history. Never. Even the opening of the American West via the railroads post the American Civil War has nothing to compare to what China has done in the last 30 years. So it would be easy to conclude that everything you've seen for the last 30 years in terms of supply would be a guide to the future. And yet the one thing you can say with absolute certainty is it cannot be that way. Because China's addition to supply came from, number one, moving a huge number of its labor force from the countryside, from being highly unproductive in the agricultural sector into the productive sector, or the industrial sector, and that is over, and the services sector, and that is over. Not only that, the Chinese workforce has begun to shrink because of its legacy of a one-child policy. So whatever we've used to forecast demand and supply for the last 30 years, one thing is for sure: the supply of products coming from China and its impact on global pricing and asset prices will change structurally, fundamentally over the next 30 years. And that's even without tariffs. And of course, we are witnessing tariffs today. Let's have a practical example. I'm not in the business of valuing steel productive capacity, fortunately. You will be, or might be. If we import steel from China, the value of British steel production and the plant and the machinery and equipment that does it is at one level. If we ban it and we say it's illegal to buy steel from China, then you get a radically different outcome for the valuation of that asset. Now, we live in a geopolitical world where these things are now becoming possibilities. I would go as far as to say probabilities that we're heading into a new Cold War. So now we're in the reverse of this, aren't we? We had this huge supply shock from China, which had a profound impact on global inflation, global interest rates, and certain key asset prices on the downside and on the upside. And now, not only is it over, but it could actually end very quickly. Just one small mistake in the South China Sea, and we will not be buying anything from China. And you get a radical change in the outlook for global inflation, interest rates, and the valuation of some assets. So some of these legacy assets that the, frankly, overproduction in China has destroyed may soon have a value, and it could happen relatively quickly. So in terms of analysing the next 5-10 years, we certainly should not rely upon China as this huge supply shock, positive supply shock. It is much more likely to be a negative supply shock going forward. So that's the general lesson. Spend as much time analysing supply as demand, but I think it's relevant today because of China. Now, one of the things we assume in finance and economics is that a government is an impartial referee. The laws of supply and demand play out, and the referee stands there in the middle, not intervening. And that's something that we've come to believe really since the late 1970s, early 1980s, because we've lived through a structural period where governments have backed away from markets. Markets did for a long time deliver what governments wanted. in terms of economic growth, in terms of low inflation, in terms of ever lower interest rates. These were things that governments, even of the left, could get behind and back. But that era is over. And when that era comes to an end, you expect more government intervention. And government intervention is there to stop the market determining prices. Let's have a very tangible example of that over the last decade or more now, which is a thing called quantitative easing. Now, that wasn't an intervention by government, but it was an intervention by a central bank to buy government bonds. And in so doing, they mispriced government debt. It wasn't the market that was the key determinant of the yield curve and interest rates over this period. It was the central bankers. That was a fundamental shift. It turned out to be one that was quite good for asset prices, certainly listed asset prices. But it isn't the only way that governments intervene to manage the yield curve and manage interest rates. And if we go back to the period from 1945 to 1979, this was managed by forcing savings institutions to buy government bonds, not the central banker buying government bonds, but forcing savings institutions to buy government bonds. And if that's the world we have to go back into because we have excessively high levels of debt, then the key question is, what are institutions going to sell to finance that? Now, we have a budget coming up in the United Kingdom. I think it's beyond all reasonable doubt that we find more government intervention in the allocation of capital. And remember, this is just not about tax rates. This is about passing legislation and regulation to control private sector balance sheets to achieve public sector goods. We have government debt to GDP ratios, which are very close to all-time highs. So certainly, back to where they were in the early 1960s, maybe not for Europe as high as they were in 1945. With government balance sheets tapped out, the governments have to rely more and more upon private sector balance sheets to achieve the public goals, whether that is more investment in renewables, general greening of the economy, shrinking supply lines, now these days building defence equipment, sadly. All of these things have to be financed, and the government will not stand by idly and let the market allocate capital in this situation. For those of you who doubt that, please read the speech, I think it's the 26th of April, by Emmanuel Macron at the Sorbonne, in which he outlines France's new industrial policy, what sectors the French state will be investing in, how they will finance it, and really importantly, why he thinks it's important that French savings are not used to fund America, but are used to fund France. So this is a form of capital nationalism, and it seems to me virtually inevitable and radically different from the last 30 years. Some asset prices are worth an awful lot more in this scenario. If you happen to be an owner of the equity that gets state guaranteed credit, for instance, you're getting incredibly cheap credit. If you happen to be the owner of an equity in a venture where the government says that you're not deserving of credit, then suddenly the equity is worth a lot less because the value of the debt is going up and the value of the equity is coming down. So government's going to pick winners and losers, and that has an impact on the assets of currently private sector institutions. Monetary policy, everybody looks at interest rates, and that's the wrong thing to look at. Think of interest rates as the accelerator in a car, but the engine, the monetary policy, is the engine. So yes, interest rates obviously very important because, as you know from driving a car, the accelerator is attached to the engine, but it's the engine ultimately that counts. And what the engine is the quantity of money in an economy. So today we have interest rates that are high, probably about to start declining, but we have no growth, or virtually no growth, in the supply of money across the developed world. And in that, I mean the United States, United Kingdom, the Eurozone, Japan. It has basically come to a grinding halt. So therefore, if one is looking at the quantity of money and not the price of money as a guide, we have exceptionally hard and tight monetary policy. Now, that isn't quite visible yet because from 2020 to 2022, we created a huge amount of money. And that huge amount of money exists as balances on the balance sheet of the private sector and has been gradually and slowly utilized and run down. So we're running down the tank, if you like, of the money created from 2020 to 2022, but it is really running down quite quickly now. And what we're left with is a lack of money. Now, I think a must read for anybody in any profession, insolvency or otherwise, is a little article the Bank of England put out a few years ago on their website called How Money is Created. It's a very quick read. I strongly recommend you read it. But the bank put forward a simple and obvious proposition to a financial historian, which is refuted by actually quite a lot of people, and that is that money is made by commercial banks. It is not made by the central bank, and it is not made by the government. It is made by the commercial banks. So a financial historian wouldn't tell you that's been happening since the 17th century, but the Bank of England needed to put it on their website just a couple of years ago to make that point. Why is that important? Well, it's very important because whoever controls bank balance sheets controls the supply of money. And in that period from 45 to 79, that last time when we were grossly over indebted, the governments controlled the growth in bank balance sheets. It wasn't done by central bankers adjusting interest rates to try and make sure that the growth in the size of bank credit and therefore money was at the right level. It was done by the government mandating exactly what levels of credit growth should come. And this, in my opinion, is a world that we're going back into. The government needs the institutions to fund all these things we've discussed. It also needs a relatively high level of growth in money because we need high nominal GDP growth. We need a little bit more inflation if we're going to inflate away our debts. And therefore, we're moving away from this world where monetary policy is interest rates. That's complete nonsense. Read any history of the post-World War II banking system, particularly for Europe, anywhere in Europe, the United Kingdom, France, Germany, and you'll see that we did not control monetary policy by using interest rates. We used the growth in bank credit. So this is an inherently politicized financial system, an inherently politicized banking system. And as I mentioned earlier, actually, if you're on the right side of this, pretty good, because you're going to be getting, as a business, subsidized credit. But if you're on the wrong side of this, you don't. Let me pick out, I don't know whether I should do this or not, a loser in this scenario. So I think it's private equity. I think a government will frown upon the use of credit to gear up an existing income stream when what it needs, desperately needs, is investment to build new income streams. Now, whether that's renewables, replacing all the stuff we don't buy from China anymore, these sorts of things. The time of financial engineering, which was using credit to gear up an existing income stream for the benefit of the shareholder, is over. And it may end quickly or it may end slowly, but I think some of you will be aware of the BEPS, base erosion profit sharing legislation, which was agreed really across a vast range of countries. So I think that was the first little inroad to the government saying, here's something you can't use debt for. In that case, it was transfer pricing of profits for tax avoidance. So we have begun that movement now, and that's a politicization which is radically different from the past. Now, I have a 90-minute lecture on this, so I'm not really going to go into it in any great detail. But it is often thought that the only way stock markets come down is a crash. If I say stock market and you think, what's the word that comes most naturally after that? You'll probably say crash. But actually, there is another way that you lose money on stock markets, and that is a prolonged decline in the valuation, not a crash. And we have two historical examples of this for the United States, which are 1901 to 1921 and 1966 to 1982. These were volatile markets, so there were some times when it looked like a crash. But effectively what you have is a market that's going sideways in a volatile fashion for a prolonged period of time, 20 years in the first example, 16 in the second, but pretty good nominal corporate earnings growth. Stress on the nominal corporate earnings growth. And as a generalization, if you enter a world of inflation, you're much more likely to see that pattern of a volatile but sideways moving stock market in terms of price, reasonable nominal earnings growth, and a valuation which is high coming to a low. So we have to pick out the US stock market in this regard because it's 70% of the global stock market, almost 70%. And it is an exceptionally high valuation. There's a measure of value for equities called the cyclically adjusted PE, also known as the Shiller PE. And for America, we have that data going back to 1881, and this is the second highest level. Today is the second highest level ever recorded for that valuation. So I'm not an accountant, as you can tell from this presentation, but I do know that inflation accounting became a rather big topic in the 1970s. And I suspect may become a reasonable topic again, because there are illusory profits that come along when you have this scenario, and illusory loss, I mean, not illusory losses, but there are issues for cash and cash flow if we repeat something a bit more like the 1970s. But there's also illusory profits that can come from this as well. For those of you wanting a bit more detail, Warren Buffett's, I think it's available online, wrote a little article in 1977, called How Inflation Swindles the Equity Investor. And that is largely focused on accountancy, actually, and how accountancy missed some of the issues going on in a period of higher inflation. Yes, it focuses on that issue of valuation, but I think you'll find much more. So that was Forbes magazine, 1977, How Inflation Swindles the Equity Investor by Warren Buffett. I spend less time talking about this than I used to, but I used to be told that inflation would never return because Jeff Bezos wouldn't allow inflation to return. That as long as there was an Amazon, there wouldn't be inflation. That as long as this technology kept coming along, the price of goods must go down. And it's not true. And the obvious way to show it's not true, well, these days it's just to point to the last 3 years when the technological revolution continues, now also in artificial intelligence, but we've had dramatic price rises. But the more obvious one is to go back to 1900 and look at the sort of, let's just say, rather large technological changes since 1900, but all of them accompanied by a higher general price level. So there is, everybody has their own biases when they come to forecasting, but my bias is that inflation is is at all times and everywhere a monetary phenomenon. And a government that creates enough money, or a central bank that creates enough money, can defeat any deflation from technology. So for instance, let's take digital watches. I think the first digital watch from the early 1970s was about $800 US. And certainly recently, it was possible to get them virtually free in a packet of cornflakes. Now, over that period, you saw technology destroy the value, the value of or the price of a digital watch. But the general price level is up hundreds of percent since the early 1970s. So if you print that money, it's going to find its way somewhere to get into the general system. So we can keep talking about technology and its inherently deflationary approach, but as long as our politicians and central bankers are free to print money, it does not guarantee us this structural deflation, which just a few years ago was really something that everybody was talking about. Once again, I could talk for a very long time about this, but monetary systems fail about every 30 years. And we get used to that monetary system. It's the water we swim in. I think I'll quote a very old quote now about the two young fish swimming along one day, and an old fish comes in the other direction. And the old fish says, "Morning, boys, how's the water?" And the two young fish swim on. And then one turns to the other and says, "What the hell is water?" So if you're a young fish, you live in the system, you sort of breathe in the system, you exist in the system. You don't know that it's even possible for there to be another system. And one morning you wake up and it's there. So I date the birth of our current system to the devaluation of the renminbi in '94. It's linking to the US dollar and the distortions that have come from that. Prior to that, 1972, ended the Bretton Woods Agreement. In 1944, we launched the Bretton Woods Agreement. In 1932, we left the gold standard. So these fundamental shifts in the structure of the monetary system are not as infrequent as you think they are. And particularly if we're entering a Cold War with China, this one's going to change, and it's going to change very soon. And there's a really simple lesson about all of this. Everything that you learned in the old system is very probably wrong. Now, that's not a lesson that people want to learn, because I've built my skill set on learning and understanding how that old system works, and I don't want to admit that these are legacy skills. So what is the fundamental change that's coming? A float of the Chinese exchange rate, an end of the link with the United States dollar, an end of the Chinese pouring money into the US Treasury market, a China ostracized from the global trading regime, therefore a force for inflation and not deflation. And internally, what we've already discussed is a need to inflate away debts. Now, that is the antithesis of the last 30 years. So we need to learn new skill sets. Now, I'm here to tell you that you can learn those skill sets through financial history, and particularly studying the last time we did this. So the good news is we've done this before. We know how it works. And that is, we can do that by studying the 45 to 79 period. So there's so much more to say about that. But let's begin to think about a world where we don't have the old system and have this new system. And it's a world inherently of more inflation. It's a world inherently where interest rates tend to rise. And by interest rates, I mean bond yields. But also it's a system where they can't be allowed to rise. Given the levels of debt to GDP across the developed world, we're going to have to find a way to stop them going up. And going back to 45/79, the way you stop interest rates going up in this world is you force savers to own them. It's not that long ago that if you were retiring, your pension fund had to go into an annuity. You were forced to buy effectively government bonds. We abolished that, but I think it's coming back, or something along those lines is coming back. So when we talk about the power of the state, we talk about fiscal policy. I'm saying they're going to get back into the business of monetary policy. But perhaps the most powerful part of the state is the bit we don't talk about, which is its regulatory policy. And it's the regulatory policy now which can force people to buy government bonds, and therefore a whole new monetary system. Negative real interest rates enshrined for a prolonged period of time to reduce debt to GDP. What does that mean for asset valuations? What does that mean for corporate cash flows? And what does it mean for inflation accounting? Never trust a forecast with a decimal point, especially your own. I have been advising financial institutions for 30 years. I've never used a decimal point to talk about the future. I have to admit, I've used them to talk about the past. Even when I'm talking about the past, I think it's slightly disingenuous to be using decimal points. But anyway, we need to know what we're counting. The ability to count is a wonderful thing, but you've got to know what you're counting. And in my view, that's the joy of financial history. It can tell you the right questions. I run the course in practical history of financial markets. We've run it for over 20 years. And I sort of annoy people because I say, you've come to a course which probably doesn't have any of the right answers, but we really think we've got the right questions. And in finance, it is my opinion that many people spend their lives getting all the right answers to all the wrong questions. Not quite like Eric Morecambe, but something similar. And it is time to try and get the right questions. And the right questions are not necessarily, possibly, but not necessarily answerable with the use of the decimal point. Because I don't use a decimal point, I often find myself standing up to present in competition with someone from an investment bank who wields the decimal point with great precision and even sometimes puts two numbers to the right of the decimal point. And the general view from the audience would be that one of us is telling a story and the other person is, doing a forecast. We're both telling a story. But the person using the decimal point is telling a story with a faux precision that makes you think that person is probably correct. And there are two problems with that decimal point. Number one, either it's being used to mislead you, to convince you that this person is very good at what they're doing, or that person actually believes it, and it's a sign of gross overconfidence. And finally, I say the most dangerous decimal point is the one you use yourself. Because in using it, you are convincing yourself that you know the future with a high degree of precision. And it's bad enough if somebody else uses it to mislead you, but if you're misleading yourself, you've really got a problem. So obviously a range of outcomes is what we're looking for there. You'll tell me in the Q&A as to how difficult that is in the world of accountancy, but it's certainly in the world of investment, something we have to be more open to than to be enthralled to the decimal point. I think financial history can help us with this. And finally, no presentation on financial history would be finished without misquoting Karl Marx. So Marx famously said that religion is the opiate of the people, but actually after 35 years in finance, I would say it's extrapolation is the opiate of the people. Straight line extrapolation is the opiate of the people. I moved to Hong Kong in 1995 to write strategy for what was then up and coming to become one of the leading investment banks in Hong Kong, a company called CLSA. And I wrote this above the door. I printed this out. Actually put, rather than this, I put no extrapolation allowed. And I put it on the door and I put it behind me. It sat behind me, just above head height. And every single person who sat down in front of me at my desk got into the business of extrapolating. Now, that's not a criticism. It's just human nature. Humans abhor uncertainty. There is a lot we can say about humans, but one thing we can say with great confidence is they abhor uncertainty and they seek the comfort blanket of certainty. And in the future, and looking to the future, the easiest way to do that is to extrapolate. So it happens every day. We are, as human beings, we're all prone to it. You're never really going to break away from it properly. But one thing that financial history can do is to help you understand that extrapolation is not the best tool for the future, particularly if you live at a great structural change. So the point of these comments this morning are to say we live right on the cusp of one of these moments of great structural change. That extrapolation, if it ever cut it in the past, it's certainly not going to cut it in the future. I've given you 8 reasons as to how I think the future might look a little bit differently than it has done in the past. Usually I give 21. One of these lectures is usually 90 minutes. So there's plenty to talk about in terms of what financial history can tell us about this future. But remember, extrapolation is the opiate of the people. And as we sit on the cusp of this great structural change, it's time to start thinking about different futures and different types of futures. And I think financial history can help us. So at that stage, I'm going to open for Q&A. We've got 10 minutes for Q&A if anybody would like to ask any questions.
Okay. First question for you is about the, I guess, Scotland's financial landscape and the current challenges and opportunities facing Scotland's financial sector. You know, it was a very, very strong sector. Now it's not. Yeah, how can historical lessons inform our strategies going forward?
Yeah, so the bit I'm more familiar with is clearly investment management rather than banking. I'm not sure that much can be done about banking. The two great banks have gone, and I don't think there's much chance of bringing them back. In terms of investment management, we're looking at a world where that huge pool of savings, which is run by investment managers of all hues, and that includes life insurance companies, pension funds, mutual funds, etc., is more likely to be under government direction. I think direction is better than the word control. So I think the important thing is to try and find freedom to the extent that it's possible to do what's right for the client, because so many people will be forced to do what's wrong. Well, in my opinion, we'll see whether this works out, is wrong for their client. So bringing up small, perhaps boutique investment management companies that are able to have that flexibility. You know, if you're running hundreds of billions, it's quite difficult to have that flexibility. But my strong view is that there are a huge number of shares and equities that you can buy to actually profit from this. But, and it's a big but, they're not in the listed sector, or sorry, they're not in the index. They're relatively illiquid, not illiquid to the extent that you and I would think so, but relatively illiquid. And therefore, it's the small investment management companies that can prosper from that. So in my opinion, what Scotland needs to do more of is to encouraging the next growth companies in investment management. And I think it's done a really bad job at that, actually. I don't think it's done a good job at that. So I think there's still something to be done there. We're lucky that Edinburgh in particular tends to attract really good talent from all over the planet. And you don't have to be Scottish to come and work in the Scottish fund management community. So more should be done about that. In terms of the banks, I think it's too late. I mean, that's just the reality. By the way, I run a financial history walking tour. We have an app, financial history walking tour app, which you can find from Library Mistakes. It's kind of depressing to do that because you walk past these buildings that used to be the home of great financial institutions, and frankly, they've gone forever and they're not coming back. So the idea that you lure them back is not what you've got to do, is start creating new ones. And we don't know who the new stars of investment management will be for the future. But Edinburgh does have some advantages. Edinburgh in particular has some advantages at starting those. It has a nice infrastructure. It has a critical mass. That's all I can recommend, really. I don't have a long list of things that can be done, but I think for banking, it's gone. Most of the great life insurance companies have gone. This was part of the globalization. They've simply gone. So there's not much that can be done, but creating a better, healthier infrastructure for startup fund management companies would be a good place to start in all asset classes, listed and unlisted.
Yeah. Okay, thank you. I'll have to look up that walking tour. Sounds interesting. Going back to you mentioned first quite early on about private sector finance and renewables. Just putting again with Scotland, there's massive opportunities in Scotland in the energy sector and renewables. I think that many people think that private sector finance is the answer. What do you think in terms of accessing and making those investments in Scotland?
Yeah, so it has to be private sector financing because the government balance sheet is not in a very good state. And of course, I'm talking about UK government. I can't talk about the Scottish government because the Scottish government refuses to issue bonds. It has the right to do so. I mean, albeit in a limited way, but it point blank refuses to issue those. So, I mean, one thing the Scottish government could do would be issue some bonds to establish what the creditworthiness of the Scottish government is, to see whether it's capable of this. So the way we do this is, if you think what happened during COVID, the way this was all manufactured was the government provided guarantees to banks and said, if you lend money to these people, we'll guarantee that you get the money back. Now, that's an interesting way of doing it when you think about that. Some of those are being called, some people have defaulted and the government is getting called, but it's a contingent liability on the government. But banks, you see, are the only private sector institution in the country that can expand their balance sheets to infinity. They are not, fractional reserve banks are not restricted, and they create their own liabilities when they create assets in the form of money. So I think what we're going to find are these banks being used for this. Now, the Scottish government can't do that because the Scottish government doesn't have a balance sheet. It's not prepared to discuss what its balance sheet is. So if that's to be the future, and in my opinion, it is the future, and I kind of discussed it, then those guarantees will come from Westminster. We only have one, as far as I'm aware, one outstanding government guarantee on a future liability in Scotland, and that is the Lochaber aluminium smelter. That one's yet to be valued properly, I think. So Westminster, I think, will guarantee bank loans and guarantee bank loans to the renewable sector and elsewhere. And that keeps it off the government balance sheet. Obviously, I mean, you're all accountants, so you know about contingent liabilities, but it keeps it hidden off the government balance sheet. And I think that's the way that they'll do this. So I expect the great big banks to be, what's the right word, press-ganged or brought into the fold on this, and they will be the main funders of this. And of course, in the process, they create a lot of money. You know, if banks create money and the government makes them lend money, they create money. It gives you higher nominal GDP growth, higher inflation. The last 30 odd years, we grew a lot of the economy through the issuance of bonds, corporate bonds. And when you issue bonds, you don't create money. So funding all of this through the banking system has profound impacts for the supply of money and inflation, and not just for the future of bank shares. The bigger question, which I'll not try and get into here because it's a long discussion, is this good or bad for the price of bank shares? If the government gets involved, intuitively you think it's bad because state involvement is bad. But actually, for many years, it could be quite good for bank shares. So we're going to see banks coming back. The great mistake after the great financial crisis was to say that banks were evil. Well, whether true or not, it's irrelevant. They're also necessary. So I think that's maybe a lesson that's been learned, and we're going to see much more active banking in conjunction with government rather than government finance directly.
Likely to be problematic should there be more investment and focus on emerging markets such as India, Africa, other Asian countries?
Yes, the answer to that is yes, but don't forget Airdrie. Now, I mention Airdrie as an emerging market simply because actually the relocation of productive capacity from China, yes, of course, you're going to look at India. But actually it's coming everywhere because there's a couple of things going on there. Yes, there's the China risk, but also one of the reasons that this is being done is because of the supply chain risk, that it was too long. That was a lesson of COVID. So I'm very optimistic on the Indian economy and its ability to attract capital and emerging markets generally. So the answer is yes. But I just wanted to expand it to say that this has ramifications for Airdrie as well, and Northumberland, and Derby, and Stoke, and maybe even one day Belfast. These places are actually relatively competitive at global prices, particularly when we consider the supply lines and more robust supply lines. So we're looking at a re-energization, not just of emerging market and capital flows, but elsewhere beyond that into the developed market, and probably to places that have been really under the cosh for 30 or 40 years. That capital is coming back, that investment is coming back. So for all sorts of businesses, yes, it's emerging markets, but you'd be surprised that, I was talking to a big global multinational very recently. They're talking about moving their production. I expected them to say India, and they said Lincoln, Nebraska.
Okay, thank you. Just got a minute and a half or so. What's the most important lesson the current UK government can take from financial history?
Well, all governments, whether it's Labour or Conservative, have the same problem, which is an excessive level of debt relative to the size of the economy. And that's not just the government, it's in the private sector. And therefore, all recessions threaten to turn into depression, threaten to turn into financial collapse. So it's not a lesson that I would put forward if you were in a different place. But as we say in Ireland, it depends where you start. Dealing with that problem is the number one problem. And this is going to get me lots of hate mail from all my friends in the financial services, but 2% inflation is too low. It's not going to get us out of this problem. So I would recommend 2% inflation for a country that had low levels of debt to GDP, but constantly telling the central bankers to get us back to 2% is getting us into a trap, a trap overlaid by our pretty poor demographics in terms of government spending. So at some stage them, and if it was a Conservative government, they'd end up in the same place. So we're going to get there eventually. Nobody wants to give up what is a important political target. But that target is going to have to be given up. And frankly, the sooner they get there, the better, because there are no good ways to deal with this. If you're excessively geared, you have austerity, default, hyperinflation, or marginally inflating away your debts. So not ideal, but much better than the other three. I mean, there is another one, productivity revolution. But that one, I think, is delivered by the private sector, ultimately not within the gift of the public sector. So I think that's the realization. It's probably coming very soon. I'd be surprised if they didn't get it in the next couple of years.
A few more questions come through, but we're not going to have time to answer those. So thank you very much, Professor Russell Napier, for that 8 lessons in financial history for the way we live now. Thank you. So now we have our first of 4 legal bite-size updates. We've got Stuart Clubb with a corporate update now. Stuart is a partner and solicitor advocate with Shoesmiths based in Edinburgh and heads up the Scottish Dispute Resolution and Litigation team in Shoesmiths Scottish Restructuring and Insolvency Group. Regularly advises insolvency practitioners, companies and directors on all aspects of insolvency law and has acted on a number of high-profile insolvency cases. So over to you, Stuart.
Thanks, Shona, and welcome to part 1 of the 2024 Corporate Insolvency Legal Update. This year, we're once again counting down the top 10 corporate insolvency cases of the last 12 months. Today, I'll take you from number 10 to number 6, and then tomorrow we'll count down the top 5 cases. Now, there's been a lot happening this year, so without further ado, let's kick off our chart rundown and find out what's at number 10. And it's a decision of the Inner House of the Court of Session from July of this year in the case of the liquidators of DMW SHNZ Limited against Bank of Scotland, a case concerning, as you might have guessed from the title, the question of shadow directors and directors' duties. Now, as we all know, when a company enters insolvency, the IP is required to investigate the actions of the directors of the company, and that also includes any shadow directors who, while they may not have been formally appointed, are nevertheless bound by the same legal duties, breach of which can lead to them being liable for any loss or damage caused to the company. So what had the liquidators to investigate in this case? Well, by way of background, the company was a subsidiary of the bank, and in turn the company had its own subsidiary which it sold, and that sale gave rise to the company having a deferred future tax liability. Several years later, the bank sought to mitigate that liability by implementing a tax avoidance scheme, which was known as Project Raindrop, named as such because it was described as tiptoeing through the raindrops of complex anti-avoidance rules without getting wet. Now, the actual mechanics of the scheme are fairly complex to say the least, but suffice to say for today's purposes that part of the scheme involved the company divesting itself of £26 million. However, the scheme ultimately failed, and to continue that Project Raindrop metaphor, the company got soaking wet. It was left with no money, no assets, and a £26 million tax liability. The company went into liquidation, and the liquidators then raised an action against the bank seeking recovery of the £26 million on the basis that in directing the company to participate in the scheme and divest itself of that money, the bank was acting as a shadow director, and that as a shadow director, it had breached its fiduciary duties to the company by orchestrating the scheme for its own benefit and without regard to the company's best interests. The bank defended the action, arguing that the circumstances of the case as pled by the liquidators didn't amount in law to them acting as a shadow director, and that the case should therefore be dismissed. However, both Lord Braid at first instance and the Inner House on appeal disagreed and held that the liquidators' averments were sufficient to found a relevant case of shadow directorship against the bank, and that the case should therefore proceed to proof. The starting point was the definition of a shadow director in the Companies Act, which is defined as meaning a person in accordance with whose directions or instructions the directors of the company are accustomed to act. The court then went on to state that in applying that definition, you needed to consider the whole circumstances of a particular case. And the judge also confirmed that there's nothing in that definition which excludes instructions given by an alleged shadow director indirectly, a point which was quite important in the context of this case, given the complex scheme arrangements which had been put in place. In summary, the court found that the liquidators' averments that the various parties involved in implementing the scheme were acting according to the instructions and directions of the bank were, if proved, capable of justifying the conclusion that the bank was a shadow director of the company. Now, whether those averments are in fact proved by the liquidators is a matter for another day, perhaps for another legal update as the case will now proceed to proof. But for now, this case at least serves as a reminder for IPs when investigating the actions of directors to consider whether any other parties may have been acting as shadow directors. And sticking with the topic of breach of directors' duties, it's number 9 in our chart, and this is the English High Court decision from just a few weeks ago in the case of Manolay Partners against Freed and others, which concerned claims assigned to Manolay, the specialist insolvency litigation finance company, by the joint administrators of Just Recruit Group Limited. In summary, the claims being made totalled nearly £920,000 and consisted of a claim against the director for breach of his duties, as well as transaction undervalue and preference claims against 2 connected companies, one of which claimed to be a significant creditor in the administration. Now, the defendants put forward various defences, but the defence which I think is most interest was the last resort defence put forward by them, to the effect that even if all of their other arguments were unsuccessful, which they ultimately were, any recovery by Manolay should be limited to the shortfall in the administration, less what would be paid back to the defendant company that was a significant creditor, as otherwise any recovery would, as the defence has put it, be circular, as some of the money they'd be paying would ultimately be coming back to one of them anyway. And in summary, this was termed the limitation to shortfall and circularity defence. Now, on the other hand, Manolay's position was that there was no circularity to this claim. If this defendant company could demonstrate that it was a creditor, then they'd be entitled to prove in the insolvency, may benefit from a distribution to creditors in the usual way in due course, but that didn't affect its liability in the first instance to pay what was due. It was only one of 3 defendants, and the other 2 weren't claiming to be creditors. And the judge ultimately agreed with Manolay, holding that there were no grounds for restricting or limiting recovery to the amount of the shortfall, as argued for by the defendants. The judge said, assuming that I have a discretion to limit recovery as suggested by the defendants, and it is worth pointing out here that while that was assumed, the existence of such a discretion wasn't actually determined in this case, the judge said I would decline to exercise that discretion. The payments ought not to have been made, and my starting point is that the defendants should meet the loss caused in full. Now, the judge didn't, however, entirely close the door to the possibility of a restriction being applied in an appropriate case where the recovered monies would simply end back up in the pockets of the paying parties. As he said, I can see that in a clear-cut case where there's no doubt as to the assets and liabilities of the company, and one can say with some certainty that the defendant will simply receive back a proportion of a sum that they might otherwise be ordered to repay, it might be appropriate to restrict recovery so as to prevent a money go round if there's no prejudice to other creditors. This is not such a case. And I think the key words there are clearly if there's no prejudice to creditors, as he went on to say that where the office holder has assigned the cause of action, such a restriction will cause prejudice to creditors while allowing the defendants to retain a greater proportion of the proceeds of the wrongdoing. It would also prejudice the claimant as an innocent third-party purchaser of the claim, and has the potential more generally to discourage potential purchasers of claims from doing so. And that prejudice to creditors and the purchaser of the claim seems to me to arise because the restriction argument, which the defendants were arguing for, doesn't take into account the agreement on recoveries between the IP and the funder, and the fact that therefore not all the sums recovered will be paid into the insolvent estate. In other words, just paying the shortfall wouldn't actually plug the shortfall in the insolvency and would therefore be prejudicial to creditors. The judge went on to say, there's a public interest in wrongdoers being pursued and standards of corporate governance upheld. To place a limitation on recovery in the form proposed by the defendants would discourage the pursuit of claims that the Small Business Enterprise and Employment Act 2015 was intended to facilitate, that act being the act which made it possible for office holders to assign claims, as well as reducing the sums available for other creditors. So some fairly robust policy and public interest arguments there by the judge as to why a restriction on recovery should not be imposed in a decision which will be very much welcomed by IPs and litigation funders alike. At number 8, it's error in the appointment. And as regular attendees of the conference will know, there's rarely a year that goes by without some new case law from the courts considering the validity of administration appointments. And this year is no exception, with the High Court decision in the case of Waugh against QM Systems Limited from back in July. Now, this case concerned an out-of-court appointment by the directors of the company, where there was a qualifying floating charge holder. And after being appointed, the administrators identified 3 potential defects or irregularities in the appointment, and therefore sought an order from the court for directions confirming the validity of their appointment. Now, before we get into what these defects were, it's worth noting, as the court did, the 3 categories of defect. Firstly, a fundamental defect, the effect of which is that the purported appointment is a nullity and there's nothing for the court to cure. Secondly, a non-fundamental defect, which causes no substantial injustice, and the effect there is that the appointment is valid. And thirdly, a non-fundamental defect, which has caused substantial injustice. In that case, it's open to the court, if appropriate, to make an order remedying the defect. So what were the defects in this case, and what category did they fall into? Well, the first defect was that the notice of appointment was erroneously headed Notice of Appointment by the company, when it was in fact an appointment by the directors. Perhaps unsurprisingly, that was deemed by the court to be a non-fundamental defect which caused no substantial injustice, particularly given that the body of the notice itself made clear that the appointment was by the directors. The second and third defects were considered by the court together, as they both concerned a failure to comply with Rule 3.261 of the insolvency rules, which requires the notice to be filed in triplicate, whereas only 1 copy was filed here, and for the notice to be accompanied by the written consent of the qualifying floating charge holder, which it wasn't. And the judge also considered these to be non-fundamental procedural defects. There was no doubt that the floating charge holder had consented, because its written consent was endorsed on the notice of intention to appoint, and the only reason for filing in triplicate was for the court to seal or certify all 3 notices, retain 1 on file, and then return the other 2, so as to provide both the appointer and the administrator with proof of the appointment. So a purely procedural requirement. And although the judge doesn't say this, it's clearly also somewhat a pointless requirement in the age of electronic appointment documents. So in summary, these were all no more than procedural defects which didn't invalidate the appointment, so some comfort there for both IPs and their lawyers. And we're sticking with administrations for number 7, which is who is a secured creditor, and more specifically, who's a secured creditor for the purposes of consenting to an administration extension, where, as you'll know, the consent of each secured creditor is required. And that was the question which the High Court had to consider in an application by the administrators of Too Good International Transport and Agricultural Services Limited. And the specific issue here was that there were 3 creditors who, according to Companies House, held outstanding and unsatisfied qualifying floating charges as at the point when consent was sought for the extension: HSBC UK Bank plc, HSBC Bank plc, and HSBC Invoice Finance UK Limited. However, while that might have been what Companies House showed, as a matter of fact, the only party which held an unsatisfied security as at the relevant date was HSBC UK Bank plc. As such, when they were considering whose consent should be obtained to the extension, the administrators took the view that so far as secured creditors were concerned, only the consent of UK Bank plc would be necessary, and they therefore only sought and obtained consent from them. The court then had to consider whether the consent of the other 2 HSBC companies should also have been obtained on the basis that they should have still have been regarded as secured creditors, despite the fact that by that stage neither company was in fact a creditor at all. And you'll be pleased to hear that common sense prevailed. The definition of secured creditor in section 248 of the Insolvency Act means a creditor of the company who holds, in respect of his debt, a security over property of the company. And the court considered that the key word there was creditor, stating that even if one were to construe security as including a reference to a security for a debt of 0, section 248 still refers to a creditor. A creditor that's been repaid is no longer a creditor. In summary, a secured creditor is one who's owed a debt that is secured. As I say, a common sense decision and one which provides useful clarity when it comes to seeking an administration extension. And finally, today in at number 6, it's an administrator and an officer. And a decision of the Supreme Court, which it's fair to say when it was issued last November, was welcomed by IPs up and down the country. And it is, of course, the case of R against Northern Derbyshire Magistrates Court. This case concerned the administration of USC and a pre-pack sale, which saw the employees of the company being made redundant by the administrators on the day of the appointment without the required advance notice being given by the company as employer to the Secretary of State under the Trade Union and Labour Relations Consolidation Act 1992. Now, Section 194 of the Act provides that an employer who fails to give that notice to the Secretary of State commits a criminal offence, and in particular it provides that in subsection 3, where an offence under the section committed by a body corporate is proved to have been committed with the consent or connivance of, or be attributable to, neglect on the part of any director, manager, secretary, or other similar officer of the body corporate, he, as well as the body corporate, is guilty of the offence and liable to be proceeded against and punished accordingly. Criminal proceedings were then brought against the administrators on the basis that they were an officer of the company and had committed an offence by being in breach of this section. And at both first instance and on appeal, the English courts agreed. They were concerned that if an administrator was not an officer, then there would be nothing to deter non-compliance with the requirement to serve this notice. Perhaps unsurprisingly, there was then an appeal by the administrators to the Supreme Court to determine this question. Now, as there was no definition of officer in the 1992 Act, the court considered that their first recourse had to be to the Insolvency Act itself, being the statute which both created and governs the process of administration, and to look at that Act to determine whether, as a matter of statutory interpretation, an administrator should be classified as an officer of the company. And the Supreme Court said that while there were 170 references to an officer of a company in the Insolvency Act, none of them suggested that an administrator was an officer of a company. And importantly, several of those references clearly showed that an administrator was not considered to be such an officer, with several provisions very clearly distinguishing between the two. Lord Richard stated, "In my judgment, these and other provisions of the Insolvency Act provide a clear picture that the legislation in creating the process of administration did not classify an administrator as an officer of the company in administration." And that having been established as a starting point, the court considered that, as a matter of interpretation, the 1992 Act didn't extend or expand the meaning of "or similar officer" to include an administrator for the purposes of Section 194, and the administrator's appeal was therefore allowed. Now, given the Supreme Court's general proposition and starting point that an administrator is not an officer of the company under the insolvency legislation, well, each piece of legislation will, of course, have to be interpreted in its own right, as the court did here. The importance of this decision will go beyond simply the Trade Union and Labour Relations Act. So, as I said at the outset, a much welcome decision for IPs. So that concludes the first half of this year's corporate legal update chart rundown. I'll be back tomorrow counting down the top 5 cases, and I look forward to seeing you then. In the meantime, back to you, Shona.
Thanks, Stuart. So tune in tomorrow at 10:15 to find out the top 5 in the corporate legal updates. So now we have our first sector in focus session, and this is following the feedback from last year that people wanted to hear more about specific sectors. So first up is construction, and we have Adele Macleod and Conor Bowles, who are part of Teneo's financial advisory team in Scotland. Both are chartered accountants, and Adele is a licensed IP. Adele focuses on mid-market restructuring and insolvency work, as well as has experience delivering complex expert witness engagements. Recent sector experience includes retail, infrastructure and construction, which is good because that's the topic. Conor's restructuring experience includes independent business reviews and short-term cash flow reviews across a range of sectors, including a recent insolvency experience in the construction, manufacturing and energy sectors. So Adele and Conor, welcome.
Thanks very much, Shona, and thanks everyone for joining the session. For those that don't know, I'm Adele Macleod, a director and IP with Teneo in Glasgow, and with assistance from Conor, we're going to run through a case study of the Stuart Milne Group administration that we and many others in our team at Teneo have been working on recently. We'll cover the background to the appointment and reflect on the challenges and learning points from a house builder administration which might be relevant for other similar businesses. And with that, I'll pass over to Conor to introduce himself and take us through the background to the appointment.
Yeah, thanks, Adele. For those who don't know me, I'm an Associate Director based in the Teneo team here in Edinburgh. And without further ado, we'll crack on with the presentation. As many of you will be aware, the Stuart Milne Group was a house builder focused predominantly on family homes, positioning itself at the more premium end of the sector. Historically, the group focused on the lucrative Aberdeen market, but following the period of the oil price crash in the mid-2010s and the subsequent slowdown in the northeast economy, the group sought to diversify itself into other regions, most notably central Scotland and northwest England. As can be seen from the slide here, it was a fairly sizable operation with over 170 million of annual revenues and around 330 employees. The group held active sites across all its regions and a land bank comprising both non-operational land and strategic land options. The group's secured debt was substantial at greater than 120 million, which it struggled to refinance or repay over a number of years, despite numerous deleveraging efforts from its management. Before we drill into the specifics of the restructuring routes considered and the eventual administration, it's worth just spending a couple of minutes on the market backdrop over the past few years prior to the administrations. As the graphs on the left show, and I'll draw your attention particularly to one on the top left, after a period of relative stability in the number of home sales in the UK between 2017 and 2020, the home building and construction sector experienced a number of macroeconomic seismic shocks. Firstly, we had the COVID-19 enforced shutdown of all construction activity on development sites as trading cash flows ceased. We then saw a subsequent, and you can see this on the chart here, we saw the subsequent increase in demand as parts of the economy reopened and people sought more space after being stuck at home for long periods during the lockdowns. However, unfortunately, this increased demand also coincided with record levels of cost input inflation and shortages of materials as supply chains struggled with the reopening of the economy. More recently, as we're all aware, we've experienced a period of high interest rates and inflation, and of course the infamous mini budget in September 2022, all of which have had a negative impact on the number of homes being sold and on price. So all in all, as I'm sure you'll agree, a fair amount of volatility for any sector to have to deal with. And where if you're a company with a fairly strong balance sheet and plenty of capital sat behind you, you can typically find a pathway through these macroeconomic factors and shocks. However, for Stuart Milne, given the levels of indebtedness within the group and the balance sheet pressures faced, these macroeconomic factors were always going to present a massive challenge for the group. One further impact to the group, very specific to the construction and house building sector, was the introduction of the Building Safety Act in 2022, which applies to high-rise buildings in England. The legislation was introduced in the wake of the Grenfell Tower tragedy, and in layman's terms was introduced to improve safety of buildings for not just new construction, but also to address the safety issues of buildings constructed dating back over 30 years, specifically where fire safety issues were thought to exist, centred mainly around the use of combustible cladding. Since its inception, the BSA has created obligations on a range of stakeholders to undertake remediation works on legacy developments in England. For SMG and other house builders, this has led to substantial and unexpected liabilities. And in a sector which typically operates on very slim margins, these unforeseen costs can present massive issues. For SMG in particular, this presented two main problems. Firstly, the initial liquidity pressure caused by having to meet immediate remediation liabilities on its legacy developments, and secondly, uncertainty over the total quantum of future liabilities which the group might be on the hook for. And the latter of these two problems severely impacted both interest and price in the M&A process, which we'll talk about on the next slide in a second. There are three further key points I think it's helpful to talk to on this slide that were also relevant for Stuart Milne Group. Firstly, the equivalent Scottish legislation to the BSA has not yet been finalised, and given the fact the majority of Stuart Milne's operations were in Scotland, this presented the risk of further material liabilities arising once the new legislation was finalised. The second point to note is that the BSA is largely all-encompassing, so the ability to cherry-pick and shelter specific parts of the group just didn't really exist. It's very similar in principle to a defined benefit pension scheme, whereby the liabilities can attach to whichever entity in a group is solvent and has the ability to pay. So this meant routes to achieving solvent sales of good parts of the business were effectively blocked. And then thirdly, on this page is the impact the BSA has on contingency planning considerations. The BSA, being a relatively new legislation and having not fully been tested through the courts as yet, meant that understanding an insolvency practitioner's obligations and where certain claims would rank in administration was a key pre-appointment workstream for us. We spent considerable amounts of time understanding the impact of insolvency and devising a detailed comm strategy to ensure we're on the front foot with this. Albeit, however, recognising that none of this would change the fact that the group would be unable to meet its ongoing liabilities and obligations. So hopefully the context I've given on the previous two slides there helps explain why the directors of the Stuart Milne Group need to consider options for its future, with no obvious routes to trading through its problems or a path to reducing its debts. Following an unsuccessful good book sales process ran in 2022 by other advisors, due in part to the market and macroeconomic challenges I've outlined previously, we were engaged in April 2023 to, among other things, commence a new sales process for the group and explore other options for the business. Our process had a much more focused buyer outreach than the previous process and was open to different and multiple transaction structures, such as a share sale, a sale of specific subsidiaries, and a refinancing or debt acquisition. There was considerable interest in the business, but the negative market conditions, contingent liability position that we've outlined, and challenges around price remained problematic for the group. It was clear at the outset that the value would likely break in the senior debt, and ultimately the prices that were offered were below the level at which a transaction could proceed. Other restructuring options considered at the time included the use of a UK restructuring plan, and in theory it looked possible that an RP could work, albeit the untested position in relation to compromising cladding liabilities couldn't be known until the process was actually launched. However, the main issue with the restructuring plan was uncertainty over whether it would create a viable and sellable business post-implementation. As you'll all be aware, the house building sector is extremely capital intensive. You have to purchase the land up front, further develop it, which includes the cost of infrastructure works prior to receiving any cash flows. And without a certain longer term solution for provision of this capital or an M&A exit lined up, an RP was just deemed simply unviable. The option of additional funding was also explored to give the group the opportunity to try and trade out of its troubles. However, given the levels of existing indebtedness, understandably lender appetite for this option was muted and limited. The final option explored was a managed wind down of the group's existing housing developments. However, management's forecast for this actually estimated a 4 to 6 year close down period needed to trade out these developments, and it was actually expected that the lender's exposure could potentially increase over this time. It also presented challenges from a director's duties point of view, so again was deemed unviable. Ultimately, following the conclusion of the unsuccessful sales process, the directors had no option but to enter into administration, and I'm going to pass you back over to Adele now, who will talk to the position on appointment in a bit more detail.
Thanks, Conor. So on the 8th of January, I was appointed administrator of 7 entities within the Stuart Milne Group, alongside colleagues from Teneo. Our appointments covered all group companies which held development sites in Scotland. Another group entity, Homes North West England Developments, owned the group's development sites in England. This entity had a different principal secured creditor, Homes England, and given that there was potential that secured creditor objectives may not be aligned, Homes England appointed administrators from BDO 4 days after our appointments. This meant that administrators from BDO needed to agree a transitional services agreement with us to support their administration strategy, as all employees and central functions which supported that business trading were within Stuart Milne Group Limited. By way of a quick summary of the position across the entities we were appointed to at the date of appointment, we had around 1,000 customers directly impacted by the administration, including a number due to move house imminently, as well as large numbers with unresolved snagging issues. We had 8 part complete development sites across Scotland, over 300 employees split between those aligned to specific sites and office-based positions in Lanarkshire, Edinburgh, Aberdeen and Manchester, and secured debt in our administrations was around 108 million, with substantial unsecured creditors comprising subcontractors, material suppliers and other trading liabilities. Turning to administration strategy, continuing construction in administration wasn't possible due to the limited funding available, the potential need to pay significant sums to ransom creditors, and health and safety risks. Also, we expected that buyers would find it difficult to get mortgages to buy from a developer in administration. So immediately on appointment, we adopted a make safe and hold strategy, securing active sites and addressing any immediate health and safety actions needed to responsibly mothball sites whilst we marketed them for sale. Unfortunately, it was also necessary to make over 200 redundancies immediately on appointment, relating to roles which were not required to support the administration strategy. We've noted some challenges we faced in the initial stages of the appointment on this slide, and to touch on just some of these, the geographical spread of the group's sites presented practical challenges. For example, planning to ensure that as many people as possible received notice of redundancy simultaneously directly from the administrators, and also securing all sites, including shoring up existing security measures where needed. Quick and accurate communications with reserved customers, customers progressing legals to complete house purchases and existing homeowners was very important. We had a huge volume of inbound queries, with many customers and homeowners understandably distressed at the news of the appointment. The appointment also generated a lot of political interest, with numerous MPs and MSPs reaching out to us. After holding a number of meetings with individual MPs and MSPs, Gavin Park and I joined a session which all MSPs and all Scottish MPs were invited to, so that we could give a briefing on the progress of the administration and answer ministers' questions. That was quite a daunting prospect, but it was effective in drawing a line under multiple requests for meetings, and our willingness to hold the session was very much appreciated. Finally, and I'm sure this is an issue many on the call will be familiar with, company records were not always as readily available or as complete as we would have liked them to be, which impacted every work stream. And in particular, the group traded on a divisional basis pre-appointment, and getting information at entity level proved very difficult. So this slide gives an overview of sector-specific asset classes which we're dealing with. Starting with Stuart Mill's development sites, pursuing sales of the active sites was a high priority given health and safety considerations, ongoing site holding costs and potential value erosion over time as part-built properties were exposed to the elements. It's fair to say that we weren't sure what the market reaction to the sales process would be like, given sector challenges and the geographical spread of sites, but we had strong interest and had multiple bidders for most sites. And I'm pleased to say that we've now sold all 8 part-complete development sites. The final sale completed 2 weeks ago. Each site has had its own complexities, which has impacted purchaser due diligence and contract negotiations, and there are a number of sites where third-party rights needed to be dealt with to complete transactions, with those rights secured by way of standard securities or within burdens on titles. Throughout the sales process, stakeholders, including NHBC, bond providers, local councils and Scottish Water have needed to be managed, and all have been supportive and helpful in getting sales over the line, as there is a recognition that the sale of sites to developers who will complete construction is in all parties' best interests. SMG, like many other house builders, held a portfolio of strategic land options. These are option agreements with landowners which give SMG the ability to exercise an option to buy land at a pre-agreed discount to market value following planning permission being granted. Options are at differing level of discount to market value and have different terms and expiry dates. Also, landowner counterparties are a diverse population and include farmers and family groups who may or may not have appointed agents or lawyers. Worth mentioning too that in many cases options can be terminated by landowners in the event of insolvency, or consent of the landowner may be required to assign options. We're progressing sales of options, but this has been a lengthy process, which likely won't be a surprise given the background I've just explained. And one last point to mention on options is that we found it can be possible to realise value from intangible assets associated with sites where options have terminated. For example, well-developed planning applications and site investigation reports. Finally, in terms of specific assets, which I'll touch on, we have a freehold portfolio to deal with. As I'm sure many of you will be aware, freeholds can be a controversial area. This is also not something we usually deal with on Scottish appointments. We're working with agents and lawyers to offer all freeholds to leaseholders in the first instance, following the prescriptive legal process in the case of apartment freeholds. And initial signs are that many leaseholders will take up the offer to buy freeholds. That was very much a quick overview of the more interesting assets we're dealing with. We have also marketed a freehold office building in Manchester, which we're hoping to complete a sale of over the next week or so. We've completed the sale of 14 part exchange properties of the 16 held at the date of appointment, and we're working through realising a portfolio of land assets, which is expected to take some time given the complex legal and ownership position in some cases. So thinking about what we learned from Stuart Milne, which applies to other situations, stakeholder management and a tailored comms strategy needs to be a focus. This is always important, but where the end product is the largest purchase a consumer will ever make, that comes into even sharper focus. Customer inquiries have ranged from urgent, important points to demands that dandelions be cleared. Sharing FAQs early on the company's website, if possible, helps sift customer queries to a more manageable level. Also, as I touched on earlier, we have been in dialogue with NHBC, bond providers and local councils since the very early stages of the administration, and bidders being able to pick up those threads of communication has helped get transactions over the line. Incomplete and inaccurate information adds to challenges of selling part complete developments, and linked to that point, conversations to clarify bids are very important. That bidders fully appreciate the implications from buying from insolvency is crucial. We also received a number of subject to board approval bids for sites, and the implications of this needs to be checked with bidders. These kind of clarification points let you compare bids, factoring in execution risk. When it comes to strategic land, it's difficult to assess the value which can be realised from options in insolvency. The options have a theoretical value based on discount to market value that they offer the option holder. However, landowners may have the ability to terminate options, or the detailed terms of options may impact their marketability. The sale of options is also relatively unusual in the sector. House builders typically hold on to options to demonstrate their future pipeline. Given that asset sales can take some time, certainty over administration funding is very important. We completed the first active site sale just over 4 months after the appointment. The SMG funding need was mitigated by the sale of part exchange properties, but it would be wise not to rely on this as a sole source of funding. And then turning to future outlook for house builders, I won't say too much on this ahead of the sector's panel discussion tomorrow, but the level of interest we've experienced through our active site sales process indicates that it isn't all doom and gloom in the market. And also some buyers have funded acquisitions from debt funding, so there is appetite from funders to lend to house builders in the right circumstances. And the final point I wanted to call out is that the Scottish legal position on cladding remediation isn't finalised, as Conor mentioned earlier. Clarity as to how remediation liabilities will be determined in Scotland and who they will fall to is still some way off, causing continuing uncertainty, which will be a point of difficulty for any transaction or restructuring situation in the sector. I hope you found that an interesting overview of our experience working on Stuart Milne. We haven't left much time for questions today, but if you do have any questions or want to discuss anything we've covered, please just reach out to either me or Conor.
Thank you, Adele and Conor. That was really good. Thanks. And Adele will be back tomorrow for a sector focused panel session at 11:55, along with the other 4 people who are speaking with our industry sector focus. So it is now time for a quick coffee break. During the break, you can check your diaries to see if you're available on Thursday, the 14th of November at 4:30 p.m. That's the date and time of the ICAS Insolvency and Restructuring networking event. It's going to be in Glasgow at the Exchange in Royal Exchange Square. More details will follow on the format, but the primary focus of that event will be networking, which obviously we don't really get that from our conference. So go and get yourself a tea or coffee. Check out the link. I think that's going to be on the screen while we're on a break, and get back here for 11 a.m. to kick off the second part of the morning session. Thank you. Welcome back, everyone. I hope you had a good break and now have your coffee ready to go for the next part of today. And first up, we have our the first of two bite-sized personal insolvency legal updates from James Lloyd of Harper Macleod. James heads up the firm's insolvency team and has advised on corporate and personal insolvency related matters for many years, advising creditors, banks and insolvency practitioners all aspects of the insolvency litigation. So over to James and the personal insolvency update.
Thank you, Shona. Good morning, everyone. It's nice to be back here again. I think this is the 12th year that I've been doing this, and I've noticed that if nothing else, I've got a bit fatter. You can't see that because I've adjusted the camera in such a way that you can't see that, but trust me, it's there. The purpose of today and tomorrow's sessions is to give you a case update. It's been a bit difficult this year to do that because there haven't been that many cases that are worthy of comment. I have had a number of cases for accountant bankruptcy that we've dealt with and that have actually been appealed, but they've appealed in relation to procedural aspects of the court process rather than procedural aspects of the sequestration process. But that having been said, there are a few which I'll deal with for you. The big case that I think is a big case of this year is a case that was issued by the Sheriff Appeal Court at the end of July. Those of you that attended a conference organised by another professional regulatory body might have heard Nicky Watson discuss this case and another related case. Nicky used to be one of my colleagues until he left us and accepted a job at the Death Star. But the cases that I want to deal with are those of the accountant bankruptcy against Christina Lasky as the executive dative of Peter Davis, and also very briefly a case involving Gordon McClure as the trustee of GGE. Dealing firstly with the Lasky case, albeit it postdates the McClure case. The background to this is that the debtor was sequestrated in 2010. At the time of the sequestration, the debtor lived in Peterhead. That's where his family home, where he resided with his son and his cohabitee. At the time of the sequestration, the son was aged 26 years. At that time, the accountant bankruptcy had appointed ICAS, which was then an agent of the AIB, to deal with the case for him. And at that point, what ICAS did was to instruct an action to have Mr. Davis removed from the family home. At that time, it wasn't realised, or it wasn't appreciated that the property was a family home because of the presence of the son. And when that came to light, what happened was the action for eviction was assisted. The intention was that there would then be an action raised to apply for Section 40 consent. There were, I think, some discussions, but in the midst of time, it wasn't quite clear what the nature of those discussions were, albeit the debtor and his partner said that there had been discussions about the level of the debt that the debtor was due. He was disputing a liability for VAT. And one of the things he said was that he'd given ICAS VAT returns so that they could sort the matter out with HMRC. Eventually, nothing much seemed to have happened, and as you might know, ICAS eventually went out of business. And at that point, that would be about 2017, the case was passed back to the accountant bankruptcy, who took the case in-house. And they then picked up communications with the debtor with a view to trying to resolve matters finally. That didn't prove possible, so it was passed over to me, and we served a notice in the local authority. That brought the matter to the attention of the debtor, his cohabitee, and at that point they sought legal advice. That was good because there was communications with a view to resolving matters, but unfortunately we weren't able to resolve matters, and so in 2019 I raised an action seeking Section 40 consent. The action was assisted at that time because Mr. Davis wanted to apply for legal aid, but when he got legal aid and that was sorted out, the CIS was recalled and we progressed with the action. Now, in this action, the first offence that Mr Davies lodged was that the property had revested in him by virtue of Section 39A of the Bankruptcy Scotland Act 1985. And what he argued was that you'll be aware that in terms of that section, a family home will revest in the debtor if the trustee doesn't do certain things. One of the things that the trustee can do to prevent revesting is to lodge statutory inhibition within the first 3 years. But what, and although that had been done on this particular occasion, what Mr Davies argued was that there was a requirement on the trustee to do that on each third or before each third anniversary. We said that's just nonsense. The Act doesn't require that, and because the matter couldn't be resolved, there was a debate that took place in late 2020. And after having heard from us, the sheriff agreed with us that no, the requirement was that the trustee only has to lodge the statutory inhibition once, and provided that's done before the third anniversary, that's sufficient to prevent revesting. And she did make the comment that she didn't quite think that that was what the Act had in mind, but nevertheless that was what she was bound to do. So because of that, the sheriff allowed the case to go further for evidence to be heard about whether or not consent should be granted. Unfortunately, at that time, the debtor was unwell. The case was therefore assisted because he was unwell, and unfortunately and very sadly, the debtor later passed away. Now, again, after in the fullness of time, once the debtor's cohabitee had sorted out his affairs, the CIS was recalled, and the case was eventually set down for an evidential hearing, and that took place in August of 2023. Now, for that, I headed up to Peterhead and took up one of the employees of the accountant in bankruptcy, and at the proof, there was very limited evidence led. I should say at this point, because the debtor had passed away, the cohabitee, Ms. Lasky, didn't actually have any legal representation. So the way that the proof proceeded was that we led some evidence from the employee as to level of debts, and that was it. And the matter thereafter proceeded by means of submissions. And the submission that I had made, as I always make, was, well, look, the issue here is that the court has a discretion, but the court should not exercise that discretion in a way that it would do lasting harm to the creditors. Therefore, despite any delays or whatever, the court should now grant consent. At the hearing, the sheriff did ask questions about the reasons for the delay, but the answer to that was that, well, we hadn't really got into any great detail and evidence, so whilst it was unfortunate, it wasn't a factor that actually made any great difference to the point that was before the judge. Unfortunately, the judge didn't agree with me. The judge took the view that she would refuse the order, and really she did that on for three reasons. The first of these was that she took the view that the trustee hadn't proved what the debt was. Now, you'll bear in mind that Mr Davies had been disputing the debt. The accountant in bankruptcy had investigated and was satisfied what the debt was, and we'd spoken to the statement of affairs, but the sheriff took the view that that wasn't sufficient. The second point was that she was dissatisfied with the delay. She was critical of the accountant in bankruptcy, and because there had been no explanation given as to the cause of that delay, she thought that was unsatisfactory, and that was another reason for refusing to grant consent. Finally, applying there's a case called Gourley's Trustee against Gourley, and that was the case in which I think the sheriff refused to grant consent because there was evidence that a debtor might have passed away because of all the inconvenience of having to move home. And I've always taken the view that that was at the far end of the spectrum, and in most cases the court should be granting consent, albeit there may well be these rare cases that the court doesn't do that. In a particular case, the sheriff thought that this was a case that was at the far end of the spectrum of cases, and therefore it was one in which she was entitled to refuse. So that's what she did. So we appealed the decision to the Sheriff Appeal Court, and the case took place, I think, just in early July, and that's probably quite a good decision. One of the appeal grounds was that there had been procedural unfairness. And the reason for that was that although the sheriff had taken the view, or was critical of the fact of the delay, that the fact of the matter was there actually hadn't been any evidence laid about that. And the point that was made was, well, it's just not very fair for the sheriff to draw conclusions when there had been no evidence laid about the fact at all. Mrs. Lasker hadn't laid any evidence, she had simply made submissions. And the sheriff agreed that was, the Sheriff Appeal Court agreed that was a ground in which the matter, the appeal could be allowed. Now, in relation to the question of whether or not the accountant in bankruptcy had proved the debt, or there was a requirement for the accountant in bankruptcy to prove the debt, the Sheriff Appeal Court did agree with the sheriff that in cases such as this, where there is a dispute about the level of the debt, that there is an onus on the trustee to prove the debt. Now, this is potentially a problem for trustees because, as you will know, the process for determining debts in sequestration is by the adjudication process. And what that does is it gives all parties an opportunity, or it gives creditors an opportunity to submit their claims. The trustee makes a decision. If someone's party is dissatisfied with that, there's then an appeal procedure set out that eventually reaches the sheriff. And it's for that reason that we don't generally go down the route of dealing with the level of debts in actions such as this. And the potential problem is that what you might find is that debtors, firstly, might start to dispute debts. And that means that in an action such as this, what the trustee will have to then do is get into the business of proving that there's a debt due. And that can just be, it can be a problematic thing to have to do, and it also adds to the expense, and it simply muddies the water. Now, I think in the vast majority of cases, debtors tend not to dispute debts. Debtors tend to accept that what is due, or what is said to be due, is due, especially if you're kind of running-the-mill, someone's been sequestrated because of council tax, and there's a pile of consumer debts in there. But where, if you've got cases such as this, and we quite often quite commonly, I should say, come across cases where debtors dispute the HMRC liability. This could be a problem because you may know that trying to get information out of HMRC is very, very difficult. So trying to get to the bottom of what the debt is not an easy factor. So what that means in cases where a debtor is continuing to dispute a debt, we might find that applications to get Section 40 consent, or Section 113 consent as it now is likely to be more problematic. The other area in which, however, I'm pleased that the court did agree with us was in relation to the court taking into account the delay in deciding that that was a factor that the court could take into account deciding to refuse. What the court said was that in dealing with cases such as this, the authority of back to the authority of the accountant in bankruptcy against Brooks, which you might recall I spoke about, I think it was last year or year before. And in that case, the court set out that in any case such as this, the party who's defending an action by a trustee, there's an onus on them to set out what the reasons are why a consent should not be granted, and if they don't do that with sufficient specification, well, they never get to the point of evidence. But the Sheriff Appeal Court went on and made the point that when the court is carrying out this test or this exercising its discretion, the test is to balance the interest of the creditors against that of the dependents. And whilst the delay, particularly in this case, was quite lengthy, was undesirable, that of itself was not a relevant factor in that exercise. And so to the extent that the sheriff had taken into account an irrelevant factor, she had erred, and for that reason the court allowed the appeal. The next question was what the court should do with the case. Now, ordinarily, the court might have remitted it back to the Sheriff Court, albeit to be heard before a different sheriff. But given the delays in the matter and given the additional expense, parties agreed that there was no need for the Sheriff Appeal Court to do that, and instead was happy for the Sheriff Appeal Court to go and consider affidavits that had been lodged by Mr Davis and Mrs Lasker. So having done that and having carried out this exercise itself, the Sheriff Appeal Court came back and granted consent. And in doing that, it took into account that Although the court has to, firstly it took into account that the child of the marriage was at this point 40 and was working in London, so to that extent didn't really need the protection of the court. To the extent that Miss Ceres Lasker might have been looking for protection, the court held that she wasn't entitled to that protection. Section 113, or previously Section 140, sets out the categories of persons who are entitled to protected, but cohabitee is not one of them. And although it's rather a brutal thing to say cohabitees are not entitled to protected by the Act, and it's as simple as that. What the court did say is that there may be circumstances where, for example, the cohabitee is a carer of a child, a young child, or a child perhaps with additional needs. There might be a reflected protection given to them, but they're not entitled to protection in their own rights. What the court also held was that the court, or the sheriff, had found that there was a debt of at least £24,000 outstanding, and to that extent there were debts that had to be paid. It wasn't appropriate for there to be further delays. That was the whole point of the sequestration process, and therefore it granted consent. Strangely, without even offering any delays, which I thought it might have done, but it granted consent, and that was that. There was, of course, the earlier decision of Gordon McClure and the trustee of GG, and this was a case which we referred to in the appeal. Now, it was kind of relevant because, well, I think firstly, Sheriff Principal Powell was kind of unhappy that he had two cases come before him, in which there had been quite a lot of delay. But in the McClure case, what the court had stressed again was this point that the whole point of sequestration is to gather the debtor's estate and have it realised for the benefit of creditors. And whilst there may be cases where there's delay, it was difficult, if not impossible, to consider a circumstance in which that will be a ground for refusing consent in the same way that it's done in this case. So I think the takeaway from these cases are, firstly, don't delay. Now, I think historically there has been a tendency on the part of trustees to be sympathetic to families and family homes, and whilst that's fine up to a point, you really should be making process in the interest of the creditors to make sure that assets are realised and gathered, creditors paid, and the whole matter shut down. Although if there are delays, I think you can expect to be criticised by the court. You might also be criticised by your professional bodies, and you might be criticised by creditors, which is not a good thing, plainly. But it shouldn't result in any orders for consent being refused. The second takeaway is that whereas historically trustees don't really have to get into the issue of the level of the debt, I think it's clear that where a debtor does dispute a debt, it might be necessary for the trustee to get involved in that. That, I think, is likely to be particularly problematic where debtors are disputing HMRC debts. I know that our practice is to say to a debtor, right, you go and sort it out with HMRC. As you will know, trying to get HMRC to do anything is very difficult. But if a debtor decides that what they want to do is dispute that, it might be that's an issue that becomes an issue in the context of the case. And as the Sheriff Appeal Court pointed out, of course, if there's no debt at all, if it's eventually established there's no debt, there's no purpose to consent being granted. But even in cases where the debt is less than the trustee thinks, that may be sufficient to bring it down to a level where the debtor or a spouse is able to make an offer to buy out the trustee and thus avoid the need for sequestration. Again, another important point is that the test to be applied is simply balancing the interests of the creditors against the interests of the protected parties, the debtor's family and dependents, and any factors that don't really bear on that are irrelevant. So that, again, I think is helpful because it does. We quite often see a lot of irrelevant factors being brought up, but that should have the effect of stripping these away and making it a bit easier. And of course, the final, I think, quite useful point is that cohabitees per se aren't entitled to protection of the Act. I think that's useful because we do quite often have cohabitees saying, well, it's no fair, perhaps ranging into human rights issues, but the fact of the matter is that they don't have their own independent protection offered by the Act, and therefore you don't have to worry too much about them. So with all those salutary lessons, what I'll now do is pass you back to Shona. Thank you.
Thanks, James. And James will be back tomorrow at 11 AM to provide us with a second bite-sized personal insolvency legal update. So next session is insolvency monitoring update with an overview of the findings from the ICAS and ICW insolvency monitoring visits conducted during 2023. I've got three people to introduce to you. Robert Mudge, who is the Executive Director of Regulation at ICAS. The Executive Director of Regulation, what do they do? Well, he's responsible for ensuring that ICAS delivers its regulatory functions and strategy, working closely with the Regulation Board at ICAS and ensuring that professional standards are maintained through effective processes for licensing, monitoring, investigation and disciplinary matters. We've also got Lesley Byrne, who is the Director of Regulatory Monitoring at ICAS, and she oversees the regulatory compliance and quality assurance of the members and firms. And we've also got Joanne Wright, who is an insolvency reviewer who's been carrying out reviews in Scotland throughout 2023. Thanks.
Thanks very much, Shona, for the introduction. I'm Lesley Byrne, Director of Regulatory Monitoring at ICAS, which is a bit of a mouthful. As Shona says, I am responsible for all the monitoring activities at ICAS. And I'm going to cover a bit of background today on monitoring and the key trends and themes. Joanne is then going to do some heavy lifting by talking a bit more about some of the significant findings that we find on visits. And then Robert will explain the role of the Authorisation Committee and some of the decisions that have been taken on the back of monitoring visits. So let's start with looking at the background. ICAS currently licenses 80 IPs, of which 62 are appointment taking. And our monitoring focuses on those that are appointment taking, and it's ICAS that decides which IPs are visited when. But there's a memorandum of understanding and principles for monitoring that's agreed with the Secretary of State, and that sets out the kind of frequency of the visits that we need to meet. So for new IPs, normally we're having to visit them within the first 12 months to 3 years of their first appointment on a risk basis. Other IPs usually every 3 to 6 years for a visit, again on a risk basis. And then finally, if we become aware of any concerns about an IP, we can visit at any time. And we roughly visit about 20 to 24 IPs a year. And this includes cyclical visits, targeted visits, some follow-up visits. That's where the committee has asked the monitoring team to go back and look at an IP to see if improvements have been made. And we also have something called high volume provider visits, and that is visits to firms obviously that do high volumes of IVAs and trust deeds, and they're required to be visited every year. And currently we outsource our monitoring to ICAEW, but the reports are made to the Authorisation Committee, who ultimately make the decision on what should happen after the visit. Now, before I start to look at trends, I want to give you a rather large health warning when it comes to reading any meaning into these trends. As I said, we only visit 20 to 24 IPs a year, and we are visiting different IPs every year. So when you compare one year with another, it's a bit like comparing apples and pears. But given also the very small number of IPs, it takes only a handful of very poor visits to skew the statistics. So I think you have to kind of read these trends with rather a large, unhealthy pinch of salt. You'll see that we've analysed the results here for the last 3 monitoring years. I don't know if it's very clear to you, but it's 23, 22 and 21. I'm also going to be talking briefly about 2024 as well, but we'll park that to later. Now, the possible outcomes of a monitoring visit, there's 4 different possible outcomes. The first one is no follow-up is required. And that means there's either no issues or just a couple of issues. And we haven't got a concern about the IP's ability to follow them up themselves. So we do not need to do any follow-up action with them, and everything is cleared. And that's obviously what IPs should be aiming to do. We then have what we call some issues, and that is where there are some concerns over a couple of issues, and the committee wants just a bit of comfort that those are actioned, and so there's some limited information provided after the visit, and Robert will talk through that a little bit later on. We then get into the more meaty issues on visits. Systemic issues, as the name suggests, is where there's more widespread failings found on a monitoring visit. And then finally, we have the worst outcome, which is serious issues. And this can be one of two things usually. Either there's significant widespread performance issues, and there are some concerns therefore about the IP's continued license, and or it could be just one particular issue so serious in nature that we have to have a kind of more serious visit outcome. For example, if we find an ethics breach, or if there was something to the detriment of creditors, for example. And again, Robert will talk through the authorisation committee's process there. But ignoring 2024 for now, and just looking at the 3 years prior, you'll see that in 21, there was 61% of IPs were in the black, the most serious visit outcomes, which is a very high number. But over time, that's improved. In 22, it was about a third of IPs, 33% of IPs visited were in the black, serious issues. And then it's improved again to 2023, where it was 13%. So we've seen a gradual reduction in the number of IPs with serious issues. And in the reverse of that, an increase in the number of IPs where they've had no follow-up action required. So you see that's moved over the years until 23, where roughly half, 48% of IPs haven't needed any follow-up action. So it certainly looks after the last 3 years that things are gradually improving. But it's quite difficult to kind of conclude on that by just looking at 3 years in isolation. Because if you remember what I said earlier on, we tend to have a kind of 6-year cycle. So what I've done is in the next slide, given you a bit more detail about what's actually happened over the last 8 years. And you'll start to then get a bit of a flavour for the kind of results. You'll see that back in 2016 to 18, the vast majority of IPs, around about 80%, actually managed to clear their monitoring visits with no issues. Then after that, there's a bit of a downward trajectory and then back up again. And what happened was, well, a number of things. Obviously, there's been a number of regulatory changes in that time. So in June 2017, the new money laundering regulations came out and we got a new regulator, OPBAS. In January 2018, SIP 11 came into effect. And then in April 2019, we've got the new 2018 insolvency rules came into effect. And then obviously what happened to all of us is the world went to a bit of hell in a handbasket, and for 2 years we had COVID. So you can see that there's been a downward trajectory, and then hopefully we're seeing a bits of seeds of improvement there in 22 onwards. And what I'm calling this is really the perfect storm. I think what we're really seeing is the monitoring results are a reflection of the sheer scale of challenges that IPs have been facing over this time. So not only we had all the rule changes I've just mentioned, obviously, you know, IPs have had to deal with COVID and everything that involved. At the same time, we have our two regulators. We've got this new regulator, OPBAS, on the money laundering side, which has really been pushing us on what we do on monitoring visits AML-wise. And then we've got the Insolvency Service, who have really been pushing more on risk-based monitoring. And if you look in the top right-hand corner, what you'll see is what that impact has been for monitoring. We've moved away from sort of cover-to-cover reviews now to far more risk-based monitoring, where we are focusing on things like case progression, timely dividends, employee matters, bounce back loans coming out of COVID, etc. So it's far more risk-based. So essentially, there's been a lot for IPs to deal with, and that is why I think it's reflected in the results. But what we're hoping now is that kind of storm is over, if we can call it that, and that blue skies are ahead. In other words, things are settling down and hopefully we're starting to see a bit of improvement. And I do say hopefully because I'm now going to go back to 24 results so far, and I'm afraid we've only had 4 visits so far this year that have gone through the authorisation committee. And unfortunately, they've all been in the black. They've all been serious outcomes. So what we're really hoping is that's just a blip. It's just timing. And by the end of the year, things will be better. But I suppose what I'm saying there is stay tuned for the next conference and we'll tell you what happens. It's very exciting. Anyway, going to the specifics now, I just want to talk about the kind of main things that are found on monitoring visits. And you'll see there what we've done is we've looked at capturing the main issues identified on monitoring visits in 21, 22 and 23. And it's really capturing the incidence of issues. It's not really the relative importance of them, but the times they've occurred. You'll see in grey 21, turquoise 22 and orange 23. And you'll see, just taking a snapshot there, generally the number of issues has been going down over those 3 years. Focusing on the ones in orange though, you'll see that there's been the most prevalent issues are 35% in relation to case progression and late payment of dividends. Statutory filing deadlines, 35%, that's quite often the case. SIP 11 issues, 30%. Lack of investigation work and failure to obtain books and records, 26% of IPs visited. SIP 3.1 and 3.3 issues, 22%. Employee and pensions, 22%, and AML, 22%. So these are the things we're going to focus on today, and Joanne's going to take you through a lot of these issues now and explain, you know, what they are and why they've occurred. I just wanted to point out one more thing before I pass over to Joanne. You'll see that there's new findings in relation to DCRS reporting, and that is really on the back of, we've obviously been looking at a lot of cases with bounce back loans, and we've seen some issues in relation to that. So I'm just going to pass you over to Joanne now, who's really going to make sense of all of this.
Thanks, Lesley. Let me just make sure I get onto the right slide. Just by way of a very brief introduction, I've been a reviewer with ICAW for just over 7.5 years now, and I've been carrying out visits for ICAS for just over 4 years. And Shona probably doesn't know this, but I visited her in 2019, and she was actually the first visit that we did for ICAS. So she's still here, so I'm seeing that as a positive sign. The issues that I want to cover during this presentation, it's a spotlight on common issues, but it's just some reminders as well. There's hopefully not going to be anything too technical, just sort of bringing some back to basic points to IPs. What I would say is that the issues that we're going to be covering aren't specific to ICAS. You know, they're quite common. We're certainly seeing some of them as part of our monitoring visits for ICAW. That said, some of the issues are what I would consider quite fundamental, long-standing requirements. I think you're probably going to hear me say those two words a few times. And I suppose we're slightly concerned that they do still keep cropping up. On the flip side, I don't wish to be sat here in my ivory tower. I was an IP in practice myself. I know how difficult the job can be. I feel like we've got more to look at as part of our monitoring visits, which in turn means I know that IPs in practice have got more to be dealing with. And also, as you probably know, the monitoring process is a report on exceptions. Unfortunately, we don't particularly pat you on the back for the things that you do well. So the points I'm going to be looking at really are the areas where improvement is needed. Okay. So the first slide is where we've seen an increase in remuneration issues. Obviously, being paid for the work that you do is fundamental, and the RPBs aren't in any way going to be criticising that. But we would say that for the most part, I think what we saw in 2023 and perhaps just leading into 2024 a bit have been unauthorised fees in relation to pre-appointment fees. And I think what's perhaps largely arisen is that these have been on CVLs, which have become a bit more of a common solution in Scotland. I think probably post-COVID and the delays with the courts. So we've seen an increase in CVLs. And I think it's more procedural issues as opposed to, you know, willingly just drawing fees without the appropriate authority. But what that's often meant is that we've perhaps identified it on a case that we've reviewed during the visit, and then we've asked IPs to review their portfolio, and unfortunately they've probably found quite a few issues on other cases. As I say, I don't think these have been intentional. I think what generally tends to happen on CVLs with pre-appointment fees is that the IP expects to be paid and draw their fees pre-appointment, and then for whatever reason that hasn't happened and they've drawn the fees post-appointment. And where you seek to draw fees post-appointment, you need the relevant authority from creditors. And so, as I say, I don't think it's been intentional. There's been a few instances where it's been a procedural shortcoming, or there's been an issue with a case management system where the IP didn't quite realise that they hadn't drawn their fees and they drew them post-appointment. So it's just something to be alert to. And where we do see fees drawn without valid authority during visits, we are asking IPs to refund them. So again, ideally we want to see that they're refunded during the visit, or certainly pending approval. And if you identify any other instances as part of the monitoring visit, then we would also expect those fees to be refunded as well. So I suppose the overall message is to try and make sure that you get it right first time. The other thing I would just point out, certainly on CVLs, is just the rules around what you can draw for your pre-appointment fee, and it's your costs in relation to assisting the directors with the preparation of the statement of affairs and the decision procedure. Obviously, if you've drawn your fee before you're appointed, you don't have to think about these considerations, but any fees drawn from state monies post-appointment, you need to consider this. Other shortcomings we've come across, again, probably more slightly sloppy issues as opposed to anything difficult, is where we've seen votes in decision procedures on fees and a statement of claim hasn't been submitted. It may well be that the vote has come from a former employee, perhaps even a director, and there's been an expectation that they perhaps didn't need to submit a claim, but just a reminder that any votes in decision procedures do need a statement of claim submitted, and you don't want to get it wrong when it comes to fees. Likewise, we've seen instances where inadequate notice has been given of the decision procedure, where it's just, perhaps a day, it might not be too big an issue, but where fees are involved, we think you need to be, making sure that you give the correct notice period, because if there was ever a challenge to your fees, you wouldn't want to fall short just because you'd not given the required notice. So just a reminder for doing that. We essentially think that IPs need to have robust procedures in place for drawing fees. And as I say, it's become more of an issue now that certainly in corporate cases, that you're moving away from dealing with court liquidations and going to the general body of creditors for your fees. Again, something that we've seen perhaps with the increase in using CVLs is that ICAS IPs are also doing CVLs under the England and Wales regulations. So again, there are slight differences there. You need to be providing a fee estimate if you're seeking a decision on a time cost basis. And we've also seen some issues where there's been different fee bases proposed. So where an IP may be seeking a fixed amount for dealing with sort of general administration work, and a percentage of realisations. We sometimes see a bit of conflict where we're not quite sure whether there could be a bit of duplication. So just to make sure that when you're proposing these mixed fee bases, you're absolutely clear on what it is that you're seeking from creditors. The last thing I would just say on the remuneration section is where we've come across a few cases where there's quite a lot of time costs, and we're not really seeing the evidence on the files. Quite often we'll raise the query on a visit and then we might be provided with evidence, but it's not quite made its way onto the file. So just make sure that your files stack up to support the work that you've done. And we've also seen issues where work has been conducted by an IP or a more senior member of staff that could otherwise have been done by a more junior member of staff. We appreciate that not all firms have lots of employees, to assist them with the work. But if you feel that you're doing work that could be done by a more junior member of staff, then we'd expect to see some consideration as to perhaps using a lower charge out rate. Hey. Lesley mentioned at the outset that we are conducting our monitoring visits with a more risk-based approach. Some of the key areas that we're looking at is the impact on stakeholders, and any IPs that have been subject to a visit over the last year. We'll see that the pre-visit information that we request prompts for more information. We want to see cases. We want you to provide details of cases where you've drawn fees, where perhaps a bounce back loans, you've identified a bounce back loan, and where there are employee claims. And this is largely because that there've been concerns, probably ongoing now for about a good 5 years, about potential misuse of submission of claims to the RPS and potential fraudulent claims. I think one of the key issues, and I'll also mention this when I come to talk about investigations, is securing company records, securing the payroll records at the outset. What we often find is that claims for holiday pay in particular can be subject to abuse. It's not uncommon for smaller businesses perhaps not to retain detailed holiday pay records. But we would still expect IPs to be making sure that they've made reasonable inquiries into the level of holiday pay claims. When you submit your RP14, RP14A to the redundancy payment service, you're essentially making a statutory declaration that you've made a thorough inquiry into the claims of the employees. There was a Dear IP issued in December 2020, Dear IP 117, which is basically a reminder for IPs of their duties. This says that, you know, IPs alongside the RPS have a role to prevent fraudulent claims being made. It reminds us that all of the information that IPs provide to the RPS, I beg your pardon, the RPS assumes has been verified by employee records. So if you haven't been able to obtain the records, if you haven't been able to verify, for example, the holiday claims, then you need to be making the RPS aware. Where I've seen this done well is that an email's been sent to the RPS at the same time as submitting the RP14, the RP14A, and the IP has explained that, you know, for example, the arrears of wages, redundancy pay in lieu, they've been able to extract all of that information from the payroll records, but the holiday pay, they haven't been able to. And then the RPS will then conduct their own investigations to take a view as to whether to just accept the claim on the employee's RP1. We've had a few instances, certainly in 2023, where we identified some high claims that had been made to the RPS. On one visit, just to give you a couple of examples, on one visit the RPS had paid out over £8,000 to 3 employees where they'd each claimed 30 days holiday each, and the IP didn't have the payroll records, and didn't tell the RPS that they didn't have them. On another case, the RPS had paid out just under £6,000 to 2 employees where they claimed 25 and 30 days respectively. So as you can see, that's just 2 cases and just with a small number of employees. So it can build up, and obviously it's the impact on the public purse where such claims are made and they haven't been verified. So if I can just reinforce the position, if you're not able to verify the claims, make sure that you let the RPS know. We've also seen some shortcomings where IPs have engaged third-party employee specialist firms. I think there's a fine balance to be made here. Obviously, you've engaged a third party to assist you, so you do want to allow them to get on with the work and place trust in what they're doing. But there's an element where you've outsourced that work, so you still need to make sure that you've got enough oversight as to the work that they're doing and that you've sought some verification before the RP14 and RP14A has been submitted. Again, where I've seen this done well is that the work has been provided to the IP. They've perhaps done some sample testing. We're not suggesting that you rework what the third party has done, because there would be no point in engaging them. But equally, you still need to maintain responsibility, that you've outsourced that work and that you're satisfied that the work has been done to a good standard. Last point I just want to mention is about delays in progressing claims for unpaid pension contributions. I do get a lot of pushback from IPs on visits, saying that they may struggle to engage with the pension companies and obtain the information. While I understand that can still be a challenge, we do still see instances where this can sometimes fall by the wayside a little bit. So it's just a reminder that trying to identify and submit a claim for unpaid pension contributions should still be a priority alongside with the general employee claims. This, I feel, comes up on pretty much every visit, and again, I would say it can come up on visits that I do for ICAW, and it is still a fundamental and long-standing requirement to carry out investigations, collect books and records. I think we sometimes struggle to see why it can be so difficult, where you have, especially where you have a director-led engagement, and again, we are seeing more of these, more CVLs. We think you should be prioritising collecting the books and records, or certainly collecting the crucial books and records. So whether they're physical records, electronic records, these should be collected as soon as possible. Now, I know certainly back in the day it was a lot easier when we had physical creditors meetings. You could ask the directors to bring the records along to the meeting. But we would just reiterate that whilst you've got the initial engagement with the directors, when they think that you're going to make all of their troubles go away by helping them to put the company into liquidation, this is the key time to try and secure books and records. There's Dear IP March 2008, Dear IP 80 March 2018 reinforces the requirements to collect books and records. And what this also says is that it's not enough to just say, I've not been able to collect them. And again, what perhaps I see on visits is a letter sent out post-appointment requesting the records, one chaser sent, and then that's it. We've done all we can. Ideally, you need to be speaking to the directors about this before you're appointed, teeing them up to get the records so that they know that you will want the records either on appointment or very shortly thereafter. Obviously, you've only got 3 months to submit your conduct report, so this heightens the necessity to try and get the records as quickly as possible. Where we're also seeing some shortcomings is perhaps a bit of an over-reliance on banks to provide bank statements. Again, I'll often see a conduct report being submitted and the bank statements haven't been obtained, and it's just a bit of a basic reminder that bank statements still form the company's books and records, so you should be trying to secure these from the company when you're appointed. Likewise, if the directors don't cooperate in providing the books and records, this is something that you should be including on your conduct report. It's not necessarily just around other aspects. A failure to deliver up the books and records for us is a clear matter of non-cooperation. What has become sort of quite a hot topic, obviously, over the last few years is inquiries into COVID-related financial support schemes. So aside from the requirements to conduct investigations to try and identify any antecedent transactions, to submit your conduct report, there's now the requirement to investigate whether companies have validly obtained COVID-related support and then have used it for the correct purposes. Again, there's questions around this on the conduct report, the DCRS report, and we often see that these questions have been answered to say that the IP doesn't know whether there have been any issues, but this is largely often because they haven't collected the books and records. So you can see a bit of a theme here, get the books and records in as soon as possible. One other thing just to point out is that you would need to consider submitting a suspicious activity report if you think there's been any fraudulent activity in relation to COVID-related schemes, particularly bounce back loans. This is something that the Insolvency Service and the RPBs are heavily looking into, and we will be looking at this on all of our visits. As I said, we will be asking as part of the pre-visit information for you to highlight cases where you've identified that there have been bounce back loans taken. So again, some of the simple steps to take: make sure you've got the application. If it's not in the company's records, ask the bank for it. Perhaps an accountant may have helped the company complete the application. So review the application, make sure the company was entitled to the support that they received, and then make sure that they've used the funds in an appropriate manner. And I would say that failure to submit a suspicious activity report is a criminal offence as well. So we have had some instances where IPs haven't been submitting suspicious activity reports, and they'll likely be passed on for further regulatory action. Slightly linked to the books and records and the investigations is we've seen a bit more of an upward trend in a lack of accuracy in DCRS reporting. That's possibly because there's more questions now to answer, and as I say, perhaps at the time that the IP is submitting their report, they don't have the records, they don't have all of the information. There is a facility to notify the Insolvency Service if you do come across any additional information after you've submitted your report, and there is a requirement to do that. So just a reminder about that. We've also seen perhaps a bit of lack of just what I would consider basic work for an IP to do, verification of assets. At the time of assisting directors with statement of affairs, we often get told, well, it's not our statement of affairs, it's the directors, but you're more often than not receiving a fee for the work that you're doing to assist the directors. So we do expect to see a proportionate amount of enquiries into verification of assets, last set of accounts, what's happened to the assets, and just making sure that these are considered as part of your investigations as well, and anything that's followed up after you're appointed. We've also come across some case progression and procedural deficiencies in 2023. Just by way of a reminder, one of the regulatory objectives for IPs is to ensure that they maximise realisations for the benefit of creditors and pay creditors in a timely manner. So it's not always just the case that the assets can be realised and then you can sit on the funds and pay the dividend at a later stage. We expect to see that dividends are turned around in a timely manner. We've seen some quite significant case progression issues over the last 12 months, particularly in the personal insolvency sector. And where we've seen the most common issues are perhaps on trust deeds, where the debtor has complied with all of their obligations under the trust deed. There's been a delay in the IP agreeing and paying dividends, and that in turn has led to delays in the debtors obtaining their discharge. So the impact on both the debtor and the creditors is something that we're looking at on visits, just to make sure that there's no unnecessary delays in progressing these cases. Creditors shouldn't have to wait for their payment, essentially. And I would say that we've perhaps found the issues where there's maybe been resource issues, and where the IP hasn't had enough staff to progress the closure of their cases, or they've not identified at an early enough stage, and this has led to some quite significant backlogs. I suppose what we're concerned about is that how IPs are looking to deal with this going forward. Where it can be quite commonplace is more in the volume sector, where IPs are dealing with larger portfolios of cases, but we've also seen it in what we would call standard insolvency practices, where there's been a backlog of cases. So just a reminder that you need to be keeping an eye on these, identify them at an early stage to avoid them building up. Now, this could be that perhaps diary management, appropriate reminders aren't in place, file reviews, all of these things that you know, are part and parcel of the job, unfortunately. What we've also found is that invariably where you've got a backlog of cases, this can sometimes impact statutory filing. So if cases aren't progressing, often progress reports aren't issued in the correct manner, or they're issued and they're not really providing an update on the case. It's almost like a box ticking exercise. We've also come across a couple of issues in dealing with IVAs, where the period of the IVA has been allowed to lapse without being properly extended. And again, these haven't just been in what we call the volume sector. We've also seen this in smaller practices as well. So again, just appropriate diary reminders just to make sure that you don't fall into this position. We've seen backlogs in dealing with breaches on IVAs. Obviously, there are quite a lot of firms in Scotland who do deal with IVAs, and where the breaches aren't dealt with, this is again creating a backlog in case progression. The message really is that that the creditors and the debtors shouldn't be impacted unnecessarily because of delays in progressing cases. I think we've worryingly seen a bit of an increase in issues with banking and SIP 11, and again, it's that word fundamental. It's a fundamental principle that insolvency estate monies are kept separate from other monies, and we've seen on a couple of visits where an IP hasn't had arrangements in place for proper estate accounts, so whether that be individual estate accounts or virtual accounts by under a client money style accounts. Where we've tended to see this is where issues have perhaps arisen outside of the IP's control. So there've been delays setting up banking facilities, or banking facilities are in place, and then for whatever reason there's been issues around those. Just a reminder, we wouldn't expect IPs to be taking appointments if they haven't got appropriate banking arrangements in place. And if an issue crops up and you find out that your arrangements aren't in place, then we would expect you to stop taking appointments until the matter's resolved. I've been shown, the IP's shown me a spreadsheet demonstrating that the funds are segregated, or they've provided it on their case management system, but ultimately the funds aren't segregated in the banking system, which is the key fundamental principle. I'm getting some messages telling me that I need to wrap up quite quickly, so I'm just going to try and very quickly run through a few last points. AML, we sometimes still see some shortcomings. Just a reminder that the CCAB issued a supplementary guidance for IPs, and one of the key points that it mentions is that where IPs are appointed by the court, that doesn't remove the requirement to still consider what CDD you need to obtain, and certainly that you need to document a risk assessment. Code of ethics, just very quickly, just a reminder to document, for IPs to document their considerations as to why they're choosing certain third parties, and to consider that they're receiving the best value and service for the work provided. And I think we do sometimes see there can be challenges for IPs where they are an employee and they're not an owner of the business or a director, and they sometimes don't feel like they've got the level of control. So the Code of Ethics does set out some guidance there for IPs in that situation. Moving on. Oh, Lesley sends me another message. Just, I suppose, just to summarise, really, the points that we've raised there. I'm going to move on to the next slide, actually, because that's just essentially summarising what I've covered. What are the underlying causes for this? Obviously, we give IPs the opportunity to provide their reasons as to why they've fallen foul of some of these requirements. Some of these system issues, staffing resource, lack of insolvency training, CPD. We get a variety of reasons, really, and I think it's just something to keep in mind, just to make sure that as much as possible you have the appropriate systems and resource in place to do the job properly. There you go. Thank you. I think I'm now handing over to Robert.
Thank you very much for that, Joanne. I will close this part of the presentation by talking briefly about what's normally the final stage in the monitoring process, which is where a visit report has been referred to ICAS's authorisation committee because of the nature or number of issues which were identified during the visit. Before getting into the details and in the knowledge that our regulatory committees can sometimes cause anxiety for some licence holders, I want to emphasise as best I can that the committee is very reasonable and very proportionate in its approach to dealing with monitoring reports. The focus is very much on what can be done to bring standards up to where we need them to be, which involves working with IPs on improvements. It really isn't about punishing IPs to make an example out of them. So with that in mind, and for those who haven't had the pleasure already, I'll introduce the authorisation committee. There are 12 to 14 members on the committee, including accountants and lay members. A key point I want to draw out here is the amount of insolvency experience on the committee, including the convener. This is really helpful when it comes to assessing the seriousness or otherwise of the issues which are identified in monitoring visits, and usually leads to very pragmatic outcomes. Under ICAS's insolvency regulations, the authorisation committee has a range of powers at its disposal if it considers that some action is required in response to a monitoring report. And for some visits, no action will be required and the visit process will simply conclude. These regulations are published on our website if you feel like you'd like more information. Now, in most instances, the action chosen by the committee will be at the lower end of the scale. For example, directions for the IP to do something and to demonstrate this to the committee within a certain timescale. However, for the most serious cases, which thankfully are very rare and usually don't happen overnight, there are powers to fine, suspend, and even withdraw licenses. Now, one thing I don't think is terribly well known is that all of the insolvency bodies, all the licensing bodies, are working towards the same standards when it comes to formal action. Around 10 years ago, in an effort to increase consistency in regulation, the Insolvency Service and the professional bodies worked together to produce a common sanctions guidance for insolvency issues. And this is considered by both of our regulatory committees when deciding how to deal with issues. This slide includes a sample of 2 offences from the sanctions guidance just for illustration. What these show is that there are differing levels of orders and fines depending on the seriousness of an offence. Before deciding on an outcome, the committee may apply a range of mitigating and aggravating factors, which then impact the order or financial penalty. This means that the outcome may be lower where an IP has taken positive remedial action in response to a breach or has otherwise demonstrated good insight. Alternatively, it could increase in seriousness if there's been a lack of cooperation with ICAS. Again, the sanctions guidance is available to view on the ICAS website, and hopefully this brings more transparency and predictability to the process. As noted on the slide, the outcomes are published by the bodies themselves and also by the Insolvency Service, which again will hopefully foster confidence that concerns have been dealt with and in a consistent manner. So bringing what we've discussed together, this slide lists some of the outcomes applied by the committee to the issues which Lesley and Joanne have outlined in their presentation. You will see various directions for follow-up action and remedial action, which should add weight to what I've already said about the committee adopting a proportionate approach. There have been regulatory penalties offered by the committee, but these are relatively infrequent. If you want to stay up to date with these, then please keep an eye on the ICAS website and also in the CA magazine. I know that the disciplinary and regulatory notices tend to be one of the more popular parts of the magazine, in addition to the obituary section, for better or worse. So before concluding in the committee, I will exploit my time here to encourage everyone to consider applying for a role, either on the authorisation committee or indeed on any of ICAS's many governance bodies. We're always keen for members with practical experience, so it's excellent CPD. Sometimes you'll get a fairly nice lunch. Information should be searchable on the ICAS website, but I'd be delighted for anyone to contact me directly about this. So moving swiftly on, conscious that I have a red clock staring down at me here. So this is the final slide, and it's a repeat of one of Lesley's earlier slides, just to serve as a reminder of some of the main issues we've been seeing on visits, hopefully to give you a helpful nudge in terms of issues you might want to pay closer attention to. Now, again, echoing what Lesley said earlier, we appreciate that there seems to be a constantly expanding list of laws, standards, guidance, etc. for practitioners to have to bear in mind, not to mention the colourful characters you will encounter every day. As I've tried to emphasise, it's not about ICAS trying to catch out IPs as part of our regulatory processes, but rather we're all working towards a shared aim of keeping standards in the profession at the highest level possible. So that is the end of our presentation. Hopefully it wasn't too stern. I'd like to give my thanks to Lesley and Joanne for their input and also to all of you for listening. And please do remember, if you ever have any query or concerns in relation to your work, then don't hesitate to get in touch with ICAS, and our teams will certainly do the best we can to assist you.
Thank you to Joanne, Robert and Lesley for that presentation. I didn't know I was your first ever Scottish review, Joanne. Very honoured, and I can confirm that the lunches are sometimes quite nice after the ICAS committee meetings. So next up is a panel session discussing the direction of travel in personal insolvency in Great Britain. We've got three panellists. We've got Andrew Shore, Assistant Director of Strategy, Policy and Analysis at the Insolvency Service, with more than 20 years of experience with the Insolvency Service, who's presently managing the government's wide-ranging review of the personal insolvency regime. Yvonne MacDermid, who is a prominent financial advice expert and was the former Chief Executive of Money Advice Scotland, appointed in 2023 to spearhead a strategic review of Scotland's debt solution. So this is the Scottish Government Stage 3 independent review of the Scottish statutory debt solutions, looking at the existing frameworks for debt solutions and diligence. Menzies from ICAS, with the Director of Practice, who ensures that practitioners receive guidance, advice and support where necessary, as well as influencing UK and Scottish insolvency policy. So David is going to sort of take the ICAS RPB public interest perspective, and I think we've got Andrew speaking first.
There we go. I will leap in then, and hopefully not too soon and not beforehand. So first off, thank you to ICAS. Thanks to David for inviting me to this panel today. I'm sure everyone knows, worth saying, that personal insolvency policy in Scotland is devolved to the Scottish Parliament, and the same essentially in Northern Ireland. So the review that I'm talking about with these slides by the UK government, which I'm heading up, covers England and Wales in particular, and particularly the three personal insolvency options in England and Wales. So we've got bankruptcy, the sequestration equivalent, IVAs, so it's protected trust deeds, and since 2009 we've got debt relief orders, which are kind of map of sorts. So hopefully I've got those equivalencies right, and I'll move on. The review started with a call for evidence in 2022. The primary motivation of that was to take stock. We'd understood that the regime's evolved considerably since the last significant review, which was, all the way back in 1986, essentially, when we brought in the current primary legislation. But it's only really evolved in an organic way to meet the problems of the day, the things we think we thought needed fixing, rather than with full consideration of what it should look like as a whole and how it should work together. So we asked some broad questions that you can see on the slide there. So taking a fundamental look at the regime from the ground up to say, is it meeting its purpose? Are we, funding it correctly? Are the right people paying for it? Is it effective? Is it doing what it's supposed to do? And we ran some stakeholder events hosted by academics on those topics, just to see how people felt and what people were going to tell us. So we got 64 responses to the call for evidence, which we were very happy with because it covered a whole range of individuals and particularly organisations representing many, many more people. All four insolvency regulators responded, including David for ICAS, and we got a good range of responses with a good sort of range of ideas as to how the regime was perceived and whether it was meeting those questions. Again, it was interesting to see where we did get consensus. So the most significant theme in the responses was that, the regime should be offering a fresh start to indebted individuals. That's its purpose. That's what it's mainly there to do. There's obviously a balance to be struck between a fresh start and ensuring repayment to creditors. But the general view, not just from the debt advice sector, admittedly creditors sometimes disagree with this, but the general view was that the balance was in the wrong place and actually it needed to swing more towards the debtor. We've had comments, you can see some of them there, that the system is still retaining its Victorian roots to some extent at this point. And in part, the original negative assumptions are still there about the reasons that people get into debt and how they should be treated, which are perhaps shifted in modern times and not quite the same anymore. So again, that sort of roots of the system contrasts with the changes that have been made since, and the more modern parts of the system, which are aimed at supporting the individuals and the economy and getting people back into productivity, essentially. So we didn't get an awful lot of a consensus at all on funding. But on the effectiveness, again, we were sort of seeing, well, people say, well, the UK regime, England and Wales regime, I should say, in particular, which we're looking at here, it's well regarded internationally. People think it's worth coming to us and looking and seeing how we do things. But actually, when you get into the detail of it, when you get into the nitty gritty, actually, there are some things there that are causing frictions and aren't working quite as well as they could do. So particularly concerns that the system isn't really offering people a fresh start at the moment in various different ways. You can lose your home as a result of insolvency, and that's a pretty big consequence. More fundamentally, you may not be able to retain a bank account. You could find your payments agreement, depending on your insolvency solution, disincentivizing you from taking on more work or a better paying job, in the sense that you are going to see all of that money that you get taken to pay off your old creditors. So again, you've got these sort of indications that a fresh start is perhaps a bit lacking in the current way we approach things. Sort of mixed views on the processes themselves. Are they really achieving their purposes? But genuine concerns that the whole thing, taking the regime as a whole, these three different solutions, it's complicated. It's got different options. The different options don't work in the same way. That's confusing for people. Specific concerns about people who are vulnerable, those who aren't IT literate, non-English speakers, and there's quite a big push, which we'll see again has continued, to say, well, actually, there should be more impartial debt advice right up front in the start of insolvency. Before people start to make up their minds they want to go here or there and what they want to do, they ought to have it properly explained to them exactly what the consequences of the things they're looking at will be. So we acknowledged, that significant changes to the regime, which is what people seem to be saying were appropriate, might be necessary, and we should look at that. And so the government accepted that, okay, we'll go away and we'll continue to work with people on the future of the regime. In the meantime, though, our early work was concentrated on the, more limited improvements that you can achieve without primary legislation, mainly because primary legislation, those big changes to the structure of the regime that you can achieve with that, takes an awful lot of time, both to develop the policy, to implement it through Parliament, and then to actually put it into practice in the real world. And so, we sort of started with what can we do in the short term, what can we do to help people and to remove some of these issues. And that sort of work led to the recent amendments of the debt relief order limits, the removal of the £90 fee to enter a debt relief order, and we've managed to make a few other minor improvements along the way. But essentially, as we've always said when we were going in, this was going to be limited. It's going to be quite small what we can do, because a lot of what people are saying they want us to do are requires changes to the primary legislation, requires changes to the Acts of Parliament in which insolvency is based. So we're now sort of turning ourselves to the question of what can we do in the longer term, what should happen there. And again, as we said, we would work with people. We started here by setting up 4 more workshops with everyone to sort of say, well, okay, what do we think about the fundamentals of the regime? We understand the purpose, okay, we've got a bit of a direction on that, but if we get into the detail of this, how should people be getting into insolvency? What are the barriers that are stopping them doing so? How should we be dealing with assets? How should we be making sure that people pay back what they can? And what does it all mean for the way that we currently deal with misconduct and people who've actually done something wrong and need to be dealt with? So those 4 workshops were independently chaired. Again, we brought back our team of highly respected sort of senior academics in the field to chair those workshops, and we brought together small groups of stakeholders. We're trying for a range of voices across the piece to sort of give us an idea of what people might be thinking on those. We couldn't include everyone we wanted to, of course. I mean, it's one of the things of trying to make sure that your discussion is going to be a fruitful one and is going to be coherent. You need to have a small group of people, but that does limit the number of people you can actually fit into the room and still have that discussion. So one of the things I was quite keen to do, and we have done, is circulate the reports from the chairs of those workshops to as wide a range of people as possible to say, here you go, here's what the workshops are thinking and what we're being told. Do you agree? If you've got any other questions, then of course, please let us know. And if you've got any thoughts on these things, then again, tell us, and we can take it to our thinking as we start to develop solutions. Just to briefly go through, though, what the workshops thought and did agree. See if I can get, there we go, it's moved on. Generally speaking, we saw a lot of the same themes repeated from before, but with more detail and more supporting evidence. So there was actually quite a strong support for a comprehensive project that's going to introduce a single insolvency procedure and completely change the way that we deal with personal insolvency. But that's reflecting views that more specifically, there's a complex and overlapping range of solutions here. We've got 3 different solutions, and yet overlaps in eligibility can make that confusing for someone to decide where they need to go. At the same time, other people would look at all the solutions and say, I can't find one here that fits my circumstances, I'm falling through the gaps. There are inconsistencies in the way those solutions deal with things, particularly inconsistencies in dealing with income and expenditure and other key assets. So you've got your houses, your homes, and your motor vehicles. And there's a thought that really standardising that and moving it closer together would give people greater certainty. There's some thought from people that the upfront fees and fees in general can distort the outcomes that you see from insolvency. So I thought this was a particularly important point from the point of view of the profession and from the point of view of how we approach these things, to say, well, what we seem to be seeing, and the argument is, if someone is being charged a significant sum of money, in the better part of £1,000 to enter bankruptcy, then bankruptcy becomes not an option for a significant number of people. If someone is coming to insolvency practitioner, for example, and that insolvency practitioner can only offer one particular insolvency solution, and they're going to be charging a fee for that insolvency solution, then it becomes very difficult for the outside observer to say, oh yes, of course we can see that that person is going to be impartial in their advice and in suggesting the right solution to that person, rather than driven by their fee. And even if we can introduce something to ensure that there is impartiality, there will still remain that perception and that issue there of, okay, but is it being done correctly? So it's quite a strong push to get people into the right solution. Again, that strong push to say, no, come on, upfront debt advice. We need to make sure that people are getting independent advice before they contemplate insolvency about what they should be doing and what's best for them based on their circumstances. I'm skipping through my points here because I know we're short of time, so I don't want to run us down too much. There was a very strong sort of theme out of our assets workshop that sort of said proportionality is key when we're looking at how we deal with assets. So again, there isn't any, I don't think there was any suggestion that assets shouldn't be available to creditors where that's appropriate, but we should be looking again at the question of when is that appropriate. Look at the impact on the individual who's having this asset taken away from them and what it means for their ability to get back into society, become a productive citizen again. If you're saying to them, okay, so we're going to have to take your home off you, for example, or we're going to take your vehicle, which might well be something that you need for your to get to and from work, or to meet your obligations to your family. So with all of that in mind, we need to look again and say, well, when is it proportionate? When is it right that we take those assets and deal with them? We are seeing some suggestions that homeowners are actually completely excluded from insolvency in many cases because they find that they're unable to remortgage their properties to release the equity and then pay off the debts. But at the same time, they'll find themselves excluded from the current insolvency solutions because they know, okay, well, if I go into bankruptcy, for example, there's a very good chance that there's all this money in my house, they're going to take that and they're going to sell it and they're going to pay off my creditors that way, which is fine for the creditors, but actually means that I'm now homeless. So there's a lot to think of there in terms of how we approach things and what we do, but some general themes sort of saying, look, we need to rebalance this, start smoothing out those inconsistencies, smoothing out those gaps in the system, prevent the overlaps, and provide people with a clear route from here I am and I don't have the I don't have the money and the assets to pay back my creditors, all the way through to, okay, so I know what's going to happen to all of my assets. I know what's going to happen to me when I enter that solution or those solutions, and then through to, oh look, I've had my debt relief. I'm out of the process now, whether that's immediately, 1 year, 3 years down the line, and now I can get back into this being a full member of society again, and unburdened by that debt that's remaining. I'm very happy to, I think, talk later if we're asked about some of the things that come behind that and some of the things that flow from that. But I'm very conscious of the time that we have and the lack of time for all of that. So I will just move on to, I think, what should be, if I'm getting this right, the first poll of at least of this session, which just asks the audience some questions. So there's the poll. Should everyone be getting debt advice from a single gateway before they enter formal insolvency? There we go. So I find that fascinating, actually, because we can see the struggle there between different views on this, and the fact that we don't have a strong answer. And I was interested to see whether that would be the case with an audience that's largely made up of insolvency professionals like myself, who have a particular view on this. So sort of we're coming from a place where we understand our own expertise and so on. But yes, we've got some no's and some yeses. I think the only thing I had left to put through on this was just to say we haven't finished work on this. As you can tell, I haven't started talking about, oh, it's going to be this way in the future or that way in the future. We're still canvassing people, and we're still, as we think about what the views that we've heard and the suggestions we've had from people as to how we could solve some of the problems we're seeing, we are still open to people coming to us and saying, well, here's my view on it, and here's what I think and why. And you can see the email address there, so please do get in touch if you've got any thoughts on the personal insolvency regime, or want to or indeed want to see the output of the workshops. I'm absolutely certain that ICAS have a copy of those workshop outputs, but equally, if you just email that address there, we're very happy to send you a copy as well.
Thank you, Andrew. And now over to Yvonne to just give us an outline of the Scottish Government consultation and the position.
Good afternoon. Thank you so much to ICAS for the opportunity to speak today to you. I hope what I have to say is informative. Clearly, our work in Scotland is a tad behind my colleague in England, but as I go through, there are some similarities. We're still in the midst of the actual process itself, so we haven't yet got to conclusions, recommendations, but that will come. I also wish to thank my two colleagues that are working with me on the team. Craig Simmons, who has been involved in Money and Pension Service and HMT, and my colleague, Professor Elaine Kempson. So we have a small team that are working on this particular review, which it is an independent review, and we're reaching out to as many people as we can. So the story so far, we had a round table back in March, participants from various sectors, very similar to my colleague Andrew and their experience. We had IPs, money advice charities, academics, regulators, creditors, and so a fair spread there. And the consultation ran from May to July, and we did give extensions. We had a few that requested and we granted extensions. We're now at the point of gathering an analysis of the consultation responses by sector, so that we can actually see what particular sectors are seeing, where there are similarities, and indeed where there are differences. We're also looking at one-to-one and group interviews, and one-to-one sessions and one-to-one and group sessions such as we have today at ICAS. This will be followed up by a roundtable, and we will then look at the recommendations and discuss with everyone and encourage further feedback from the recommendations. So there's a huge chance here to actually be involved and participate. And at this point, I also wish to thank everyone that has participated thus far, particularly ICAS and others, I'm sure, that are in the audience that have taken the time to send us some really, really concrete responses and very thoughtful responses. And I'm looking forward to being able to come back to you at some point, certainly when we come to look at the recommendations. We're looking to publish our report towards the end of the year, perhaps into Q1, depending on what comes out of the actual workshops. So that's just a visual timeline for you there. So looking at the consultation questions, and we also wanted to ensure that we covered as much as possible, and there are some similarities to our colleagues in England as to some of the questions that were asked. which is good because then we have some comparisons that we can, and comparators that we can draw on. So the very first question was, what works well and what doesn't? And we have had differing views depending on the different types of products, as you can imagine. IPs at one end, money advisors, charities, regulators, academics at another point of view. So really, really important that we can pull all that together. And we, as I say, we've been working on that, looking at sectoral similarities and differences. Also, we looked at access to the system, and we have covered small businesses, and I'm disappointed we haven't had more input, but again, that can come later on in the process. And also those people with protected characteristics, whether they actually are accessing the system well. Then we looked at principles and values, and we asked some questions around what people felt about the kind of principles and values that you would like to see within our system in Scotland and what that would look like. And thank you for some of the very interesting contributions that we've had. Then moving on to think about stigma, and that was something that lots of people commented on. And I know it's been mentioned earlier about a fresh start. Again, some views that are similar, but some differing views as well. And funding of debt advice was one of the questions we asked, and also about the funding of debt solutions. And again, we got some really interesting comments made. Obviously, we're still in this period of analysing and reporting, so it would be inappropriate to be going into any depth with any of that. But I think it was interesting, the poll, the Slido that we had earlier there, about the access, whether people should access debt advice before going into any product. We also looked at a single gateway, and again, that has been a really interesting, interesting responses with regard to a single gateway. Repayments and timelines about how long people ought to be paying into, for example, PTD, paying into a DAS, and indeed, you know, should it be similar across the piece? Then moving on to the family home, which again, differing views for different reasons, and again, coming from different sectors, and that may be an area of controversy, but we will see once we get through all of the analysis. Technology and innovation, thinking about the future, we want whatever we come up with, we want it to, as far as we can, to future-proof. We also want it to be affordable, whatever comes out in the recommendations. I don't have any fixed ideas at the moment at all, but there are some interesting points of view expressed there. And certainly artificial intelligence, open banking and apps, etc., I think will certainly be featuring in some shape or form. We also have given an opportunity for other comments. So that's really the story thus far. I'm sorry it's not as long a story. Ours is a bit of a chapter of a book rather than the book itself at the moment, but we're listening. We want to hear as much as possible. And again, just to reiterate my grateful thanks to all of you that have in fact contributed. And I really do appreciate the efforts that have been made.
Okay, thanks. So now for a bit of discussion. I think what's clear is that the two different consultation and reviews are looking at similar issues, and I guess the question is, should there be broad alignment in the outcomes? Will there be broad alignment in the outcomes, and how closely are you working together in your projects? Don't know who wants to answer first.
Shall I go first?
Yeah, please.
Obviously, depending on what comes out of our consultation, where there are clear issues that require looking at it across the piece, then we will do that in every opportunity that is there to actually explore. And I've been in touch with Andrew, and I've also been speaking to colleagues at Scottish Government as well. And I want to try and have as full a picture as I can about what people feel the landscape should look like in Scotland, and then look at every opportunity to try to bring that together in whatever shape or form that we can. So I'm certainly in listening mode and very, very keen to understand more about the review that has gone on in England, to learn as well from their experience. And we are a bit further behind, but obviously we want to try and, where possible, to align as far as we can, because that, in my view, will help bring more certainty and efficiencies. But again, it's all down to what our final recommendations are.
Okay, thanks. Andrew, have you got anything to add?
I think that's right, and I think what I would say is that there are some pretty fundamental principles that have been discussed in each of these reviews, and they are, and I would be surprised if we come to very, very different answers actually in the grand scheme of things. To get a little bit political, I would say it's not impossible that we could come to different answers. It was decided, back in the day, that personal insolvency would be, transferred to the Scottish Parliament as a policy area, and for obvious reasons, there's some element of, if you transfer policy, then you must have some thought that things could be different in one jurisdiction than the other. But that's to some extent mitigated by also saying, but of course we are trying to achieve very similar things with what we're doing. I think there's some distinction you can draw between Scotland and England and Wales in the sense of, just for example, purely in case numbers. So sometimes things that do work for Scotland work because there are fewer cases in Scotland, and you can work with a smaller number. Likewise, sometimes perhaps things that work in England and Wales work because there are large numbers of insolvencies, and they work together that way. It works better that way. But I wouldn't take that too far. In terms of broad principles, I think we don't have hugely different stakeholder opinions, I think, on either side of the border here. We aren't saying, oh, well, everyone in Scotland thinks very, very differently to anyone in England and Wales. No, it's generally speaking, people are seeing the same issues, and generally speaking are coming to us with, I think, again, we're saying about the different, how far each of the reviews has coming to us with similar sorts of thoughts on, here's what the problem is, here's how we could solve it. What do you think?
Okay, thanks. So one of the contentious issues in personal insolvency is the family home, or the debtor's primary residence. Now we've got another Slido coming up, and I think just while we wait to see what the question is, should it be included or not? David, do you want to just set out the two sides of the argument?
Yeah, certainly, Shona. I mean, I've sat on one of the workshop groups that Andrew mentioned there, that was looking at the contributions and the assets and such like. And this was a really interesting discussion around the family home generally. I mean, certainly it's always been an issue, and as long as I've been in insolvency, it's been a thorny issue. And I guess what we looked at as part of that was we looked at some of the other jurisdictions, so particularly around America, Canada. And they have this concept of some equity protection. And I think it goes back to, what do we want personal insolvency to look like? you know, it's much wider than just simply the insolvency legislation. You know, one of the things I think we'd hoped as part of this wider review, which hasn't really filtered through, is that sort of cross-governmental issue. So it's a lot of social policy, a lot of economic policy. How does it tie into health? How does it tie into housing policy, and such like? And one of the issues that say came up was this equity protection, and should there be an element of protection for debtors going into insolvency? I think it was Andrew that mentioned that sometimes it's a bit of a barrier. It stops people actually addressing their debt issues where they think that there's some equity. And I think, you know, broadly from an ICAS point of view, we are broadly supportive that I think there would be some element of equity. I think it's then a political decision as to what that equity protection level is set at. But I think there are lots of really good justifiable reasons as to why there would be an element of equity protection for the family home.
Okay, thanks. Now I missed what the result of that poll was.
I think it was broadly 50-50.
Oh, 50, there you go. So interesting. Okay, so one last question. The reviews have been described as a once-in-a-generation opportunity to review the personal insolvency framework. Do you think there is desire and consensus among stakeholders for radical reform? Can it be achieved, or is it too big a problem to tackle? Andrew, a brief answer from you.
There was an interesting comment actually in one of the workshop reports, which does reflect directly on this. Essentially, people were saying, and this is, I should say, we kept government out as much as possible out of the workshops. So it was about stakeholders, about what our stakeholders think. But I think it would have been helpful to have someone with my team's perspective in the room actively contributing, I think, at that point, because the statement was, we think that there's actually quite a strong support, not universal, but quite strong support for radical change here, radical movement to, for example, for most insolvencies, a single insolvency procedure was the proposal. But then went on to say, but we think that actually that's a very big project and we should try and do something smaller in the meantime. And I think what I could have added to that discussion then, whether it would have been, how it would have changed it, I don't know, would have been to say, I think we do have actually a relatively one-off opportunity here to make changes, because government has a lot of priorities, a lot of things to do. When we come up with some answers and say, oh, here's what we think we should do, and if people agree with that, we're still going to have to engage ministers' time, attention, engage Parliament's time and attention to pass that legislation through and make the changes that people want us to make. If we were to do that on a sort of, oh, well, here's what we want to do in the meantime kind of basis, and we're to take that opportunity, take the limited sort of gold dust parliamentary time to make changes on that basis, then my concern would be to say, well, you know, I can't say that ministers will or will not come back to this, or anyone, you know, that's for politicians to decide. But there will be some concern to say, well, you've had your opportunity here. You chose, you know, people have said to us they wanted changes. We've made some changes. Now we've got all of the other problems that are facing the country to debate and to continue to solve. And we'll come back to this in 30 years, maybe. So my thought on this would be to say, we shouldn't necessarily rule out, if we want to make big changes, we shouldn't rule them out on the basis of they'll be difficult and we need to work them through. Absolutely, they'll be difficult, we need to work them through, but we should take it as an understanding that there is an opportunity here with people engaged, saying changes need to be made. And what we need to decide is, what are the changes that we want, and go for those changes, as opposed to, oh, well, can we just tweak it and then we'll come back to it? Because the answer is probably going to be, yes, we can, but it will be another generation perhaps before you get this opportunity necessarily.
I'm really encouraged to hear that, Andrew, because I think there is that need to be a bit more radical in the thinking. And I think you're absolutely right. You know, it's not possible to achieve it all in one go. But what I would be encouraging both reviews to perhaps set out is that longer term roadmap. You know, and stepping stones along the way, but be really, really clear about what the long term ambition is for personal insolvency across the UK.
Okay, thank you, Andrew. Thank you, Yvonne, and thank you, David, for that discussion on the future of personal insolvency. We now have our last session of the day and our second sector in focus session. We've got Richard Bathgate and Michelle Waugh from Johnson Carmichael. Richard's a partner insolvency practitioner, current chair of R3 with many years of insolvency experience, and Michelle is a senior restructuring administrator with Johnson Carmichael. So thank you, Richard and Michelle.
Hi there. Right, we will try and canter through this faster than planned. Here we go. Right, we'll be quick through this slide. I think I am not a sector specialist, and nor is Michelle, but we have a number of partners at Johnson Carmichael who are farmers. So Jen Stewart's our head of agriculture sector. There's been a lot of challenges you've probably read about in the news, or if you've watched Clarkson's Farm for farmers. In fact, if you've watched Clarkson's Farm, you may think you know lots of the challenges. But I think grain and rising feed prices, climate change affects crop yields, get bad weather, it's going to affect the crop yield. Subsidy changes from the EU to the UK, changing government support for farmers, changing technology. We used to get farmers coming in with a shoebox of receipts. Now they're moving towards making tax digital. So that's forcing a generational shift and more younger farmers getting involved in running their business. But probably, I think we'll zoom through that slide just now. The sector business we're going to talk about is called Balgownie Limited. This was a trade-in administration that we did earlier this year. Not expecting you to read all of this on the graph, but just to set the scene, it was involved in the agricultural sector because it sold machinery to farmers and other agricultural businesses. Been trading since 1907, so 117 years before it went into administration. The grey columns are turnover. So when I was appointed, it was doing about 29 million annual turnover, but pretty consistent revenue growth over the years, as you'll see from this slide. Light blue line is gross margin, and again, pretty consistent range of gross margin, and then the darker blue line is operating margin. So pretty consistent margins off the turnover, pretty low operating margins. But the interesting thing there is it looks remarkably consistent, notwithstanding all the challenges in farming. You'd expect with Brexit, the Ukraine war and all the prices going up, farmers might have less to spend on buying equipment, but actually seems very, very consistent. Almost too consistent, you might say, because in FY22 in the accounts there was a disclosure in the accounts that said the company had underreported VAT of 1.5 million. And there was a disclosure that it now had underreported VAT and had a big VAT arrears position to pay. So it's almost as if it got too well through the COVID years. So that's the sort of scene. Just going to the next slide here. So yeah, these were the headlines when we were appointed. Made the BBC News and the much more important Press and Journal newspaper in Aberdeen. So it was quite a shock in the local community. A lot of farmers, for example, relied on Balgownie to get machinery and equipment, and particularly spares. We were in the sort of spring season, so if your equipment broke down and you had machinery, you needed access to get your spares, otherwise you might not be able to get around the fields. So there was quite a rapid spread of word around the market about this insolvency, and it really was in the local community quite a big deal. I'll just nip on to the next slide here. So I'll let Michelle jump in here and just talk a bit about what we did, because I think it was not too many sort of chunky trading administrations now that lately that I've been involved in. So I'll let Michelle explain a bit more about what we did.
So in this case, we were lucky enough to have got out onto site pre-appointment just to get a feel for the site, the different departments and the assets that they held on site. That had now allowed the administrators to to make a decision that we could retain some employees, make some redundancies, and trade on to generate some cash and hopefully secure a sale of the business as a going concern. So day one, we were appointed quite late in the afternoon on Friday, so we had to get out on site and do the employee briefings. There were 24 redundancies and 17 employees retained on day one. We then had to secure the site for the weekend to make sure that everything was going to be there on the Monday morning and get everything insured. Then on the Monday, we really needed to start looking at the trading. So cash flows, purchase and sales ledgers, we had to maintain all of those records to make sure that we were generating enough cash to settle payroll at the end of the month. We also had to close the store for 2 days just to allow for us to undertake a stock take. Now, the site had sort of a storefront. It was a bit like a screw fix, perhaps, where you've got a showroom with all sorts of lawnmowers and hedge trimmers and whatnot that people can just walk in and pick up, but then also a storeroom to the back where there were thousands of different spare parts. So our first task was to try and do a stock take over that and ascertain where retention of title issues might lie and what stock could be sold. We also had to look at the strategy for the sales process, where the administrators would initially contact agricultural specialists such as Jen within the firm, and also our corporate finance team to try and generate some interest and market the business. What I'll do now is I'll just take you across to the next slide and sort of try and bring that to life a little bit. So what we have here is a slide showing the cash at bank at the end of each week. So day one on the appointment, we had no cash in the bank here. But by the end of the week commencing the 18th of March, there was just over £100,000 in the bank account. That was generally generated through cash sales, spare parts, people coming into the showroom, but also having staff in the background invoicing work in progress, chasing debtor balances. As we get to the week commencing the 25th of March, we've already had a date for indicative offers by this point. So the administrators were able to identify a preferred bidder that week and begin the process of arranging contracts and trying to push that sale on. You'll see that by week 3, week commencing the 1st of April, so over Easter, we've generated significant sums of cash from those sales. At this point, we had people coming in to buy trailers, mulchers, all sorts of different assets. But in amongst that, things were also starting to get tricky. There were creditors with retention of title wanting to come in and inventory stock. Some creditors were a lot easier to deal with than others. There were others who were peeved that items they thought might be on site had gone and that they couldn't just come and pick those up. As we were getting into week 4, trading was still progressing well. The administrators were liaising with lawyers, the preferred bidder. They were working with valuation agents, pulling together sales invoice schedules in terms of the assets that were there, what was owned by the company, what was owned by finance providers, and whether the interested party would be looking to take on that finance. In amongst that, things were also starting to get difficult. There were a number of customers attending on site who had bought very large, very expensive assets in cash, but were now receiving correspondence from asset-based lenders indicating that there was still finance over those assets and that they may have to give those assets up or pay for them for a second time. So lots to juggle on site, lots of sensitive conversations ongoing, and really getting to a point where there was an emphasis on getting this sale concluded. We also had daily briefings on site with the staff just to keep them updated as to how the sales process was going, how trading was going. Very early on in the trading, we made 2 further redundancies. It became clear that the 2 mechanics in question, their day-to-day job was really undertaking warranty repairs, and it just didn't look as though we were going to get paid for carrying out those repairs anymore. So decisions had to be taken to make those redundancies and save on costs. So what you'll see here is that by the 15th of April, we've got a significant sum in the bank. We've managed to sell the business successfully. But following that period, there were also a number of payments having to go out to asset-based lenders who'd agreed that we could sell on assets and pay the balance due to them, or utility bills, costs such as that come with running a business. And I will pass you over to Richard because we're a little bit short of time and having to canter through this a little bit.
So yeah, a lot of the key thing, I think the key theme was people skills and communication. So as Michelle said, that's a stock image of a couple of apprentices apparently, but it did actually look a bit like that on Balgownie. We did have apprentice mechanics and apprentices, typically your older workshop manager who had served their apprentice and knew how to run the workshop, because we did have workshop repairing excavators, and it was quite a large yard. But daily employee briefings to keep everyone on side so that there was a going concern business to sell, customers so they'd keep buying from us, suppliers so that we'd get supply. We came to a consignment agreement with a UK's largest trailer manufacturer that they would allow us to then continue to sell trailers and fulfill orders, and the interested parties. And there was just a lot going on because people were interested in how the VAT arrears had built up, and what was the story, why had the company suddenly become insolvent. So communication there really was key with the different stakeholder groups. As Michelle said, we finally sold it Friday the 12th of April, roughly a month from when we were appointed. Picture there is the new owner on the right hand side, Douglas, who was the FD of McGregor Industrial Supplies, and the chap on the left is Mike Singer, who was the MD at Balgownie. So we put out positive news there to try and get customers back in for the new owner and generate business. But yep, we managed to sell it, and that led to the secured lender being fully repaid. Probably 20 pence in the pound dividend to the prefs. There's about £2.2 million secondary pref claim with HMRC. They should get about 20p in the pound. Fortunately, I don't think there'll be any funds to the ordinary creditors, but it's the nature of the VAT arrears, and certainly a good example of where secondary pref really does matter. So key points from us. I put a picture here of computers. I think it's just very easy nowadays to sit at your desk and send an email to someone or an instant message and think you've done your job. But the reality is, if you're going to do a trading case, it is about, you need to know your insolvency law so that you can answer queries on the hoof, pardon the agricultural pun. You need to know your financials, understand your cash flow, common sense. Is the site locked before everybody goes? Who's got a key? Is the burglar alarm on? And I think somebody said it in one of the earlier sessions, early advice, the earlier you deal with these problems, the more you can try and avoid them. Agriculture, well-known saying that farmers are typically asset rich, cash poor. I think that definitely holds true, but it is a remarkably resilient sector. But it also seemed that often farmers would go down to the local mart, which was just down the road from Balgownie, sell their livestock and then just come up and buy a machine in cash once they'd got the settlement from the mart. So I think key thing from us, if you're going to do a trading job, it's not all about your computer. You got to actually go and talk to people, and that should finish us on time, I think.
Thank you very much to Richard and Michelle for that. And Rich will be back tomorrow for a panel session, which I think is our last session tomorrow, with all the other speakers from the sector focus sessions. So that brings us to a close. More tomorrow. Yeah, thanks to all our speakers today. I think there's going to be a feedback questionnaire coming out just when you log off, so if you can complete that. And other than that, I'll see you tomorrow at 9:30 sharp for day 2. Thanks very much.